Good morning and welcome to the ECB's conference, Money in Transition, Digitalization and Innovation in Payments. My name is Jürgen Scharf. I'm advisor in the Directorate General Market Infrastructure and Payments, and I will be your host for today, keeping the time, scheduling, and inform you about the logistics. We are delighted to welcome an outstanding lineup of speakers, panelists, and a wonderful audience here in Frankfurt at the premises of the ECB and online. A brief word on format. We will have 3 keynote speakers. We have 4 panels. Each panel has a moderator that guides you through the content. We will have 2 coffee breaks and a lunch break, and we will provide you with the logistics when the time has come. We will now open the conference with a keynote address from our esteemed President, Christine Lagarde, who unfortunately cannot make it in person, but we have a recorded message from her, a video, which can start now.
Good morning to all of you. Let me take you to Champagne, not for a drink, just to remind you that 8 centuries ago, the fairs of Champagne were where Europe settled its accounts. These fairs were held in cycle throughout the year, and they drew merchants from the textile towns of Flanders to the bankers of Italy, who cleared their debt against one another on paper rather than cart silver across the continent. Bills written all over Europe were timed to come due there, to be reckoned together so that great sums changed hands with barely a coin in sight. And for a time, 8 centuries ago, a divided Europe settled as one. I'll spare you the following 8 centuries, but since then, Europe has advanced enormously toward integrated settlement, above all with the euro and the systems that underpin it. But challenges never stop, and Champagne shows that what is at stake if they go unanswered. As tolls rose and new sea routes opened, the merchants drifted away, and Europe's first common market faded into memory. Today we face 2 new challenges at once. Technology is one. It is rewriting how money is exchanged and trades can be settled, most of all through tokenization. And second, geopolitics has turned the ownership of financial infrastructure into an instrument of power, so that sovereignty now matters where once it did not. Real as these challenges are, for Europe they are above all, in my view, an opportunity. In our capital markets, they offer the chance to tackle a fragmentation that has held us back for decades. In our retail payments, the chance to open the field to operators working right across Europe and to more competition. That's what we can achieve. In the euro system, we are pursuing a comprehensive strategy to seize this opportunity. It starts with one dimension: wholesale markets. Today, a single cross-border transaction passes through a chain of separate record keepers, each holding its own ledger, creating high transaction costs and reinforcing home bias. 32 central securities depositories keep these records across our union. In the meantime, the United States has 2. Tokenization offers a way past this. On a shared ledger, ownership is recorded once, and payment changes hands in the same instant as securities do, with the terms of settlement written into the instrument itself. We have been trying for decades to weave our national systems into one. Now, with technology, we can build a new layer whole from the start. But the technology settles nothing on its own. Without a credible, risk-free asset to settle in, tokenized finance will splinter into private islands yet again and will fail to reach escape velocity from its current sandbox status. The market has told us so. We have brought together more than 60 participants from across the industry, and their message was clear. They will not commit to issuing digital assets at scale until they can settle in central bank money. Nothing else is trusted and accepted by all, and nothing else can expand and contract with the market's needs so that liquidity is there when the system most needs it. A token-backed euro for euro can never do that. So we will be answering the call. Already in the course of this year, our Pontes project will settle tokenized transactions in central bank money. Our Appia project reaches further still. With the market, it is drawing the blueprint of a single European market in tokenized finance and putting Europe at the frontier of this new technology. That was dimension one. The next and second dimension is retail payments and the role of central bank money within them. The only public money we can hold today, you and me, is cash, our ultimate claim on the central bank and our connection to it. By the way, the euro system is committed to preserving cash, with a new series of euro banknotes on the way. But as more of daily life moves online, Europeans risk losing that connection altogether. We cannot tolerate that. The digital euro carries it forward. A euro issued by the ECB and available to all. The digital euro does more than preserve what we have. It is also a chance to end a dependence we have lived with for too long. Europe has no pan-European card scheme of its own. And most of what people tap and swipe runs over networks that we do not own. International schemes account for more than 60% of card payments. 13 out of 21 euro area countries have no national card scheme of their own. European schemes have never reached pan-European scale because they are caught in a vicious circle. No merchant adopts what few customers use, and no customer uses what few merchants accept. The digital euro breaks that circle. Because of its legal tender status, it must be accepted everywhere. This gives Europe, at last, a payment instrument that works across the whole Union. And because its technical standards are open, any provider can build on them and reach across Europe from the start. For the first time, European players could compete on equal terms. The third dimension is cross-border payments. Sending money abroad is still slow and costly, routed through long chains of correspondent banks. Dollar-denominated stablecoins are positioning themselves to move into that gap, promising to be faster and often cheaper than the current system. Well, it remains to be seen whether the promise will be kept once end-to-end costs are factored in and compliance standards are brought up to those of regulated providers. But the gap is there, and the case for action is clear. The G20 has recognized as much, putting cross-border payments at the center of its own reform roadmap. The Eurosystem is acting here as well. By interlinking our instant payment system, TIPS, with others, we are letting European payments reach across the world. A link to India's UPI, the largest instant payment system in the world, is now being built, while connections to the Nexus global payments network in Southeast Asia and to Switzerland's SIC IP system are in advanced stages of analysis. The aim is simple: that Europeans can transfer money to a growing list of countries around the world in seconds on rails of their own. Which brings me to the largest prize of all, the euro's international role. It has long been held back by the same fragmentation that limits us at home. Markets are too shallow, infrastructure is too divided. Put our own house in order, and that begins to change. A deep and integrated market, anchored in trusted public money, is the path to a currency the world will actually want to use. The euro system is doing its part, but we cannot deliver this vision for Europe alone. We need the market to invest in the technology and to agree on shared standards. With Appia, we are building them together so that tokenized networks connect rather than remain siloed. And we need governments to provide legal certainty through a common framework for digital assets. National regimes are already multiplying, and unless we set that framework first, we will rebuild in law the fragmentation that technology is dissolving. Let's go back to Champagne. 8 centuries ago, a divided Europe settled as one, but it did not last. What we have built since then, a single currency settled on shared rails, is extraordinary. The challenge is to carry it into the tokenized age, so that the new technology extends our single settlement rather than fragmenting it. This time, if we can keep it, it will be time for champagne. Thank you.
Thank you very much. Unfortunately, the president couldn't make it, and we have some logistical glitches. 2 of our guests are a bit late because of the arrival of the planes. Therefore, we need to slightly change the order of our events and have to bring forward the keynote speech of Markus Brunnermeier. Give me a second. Markus needs to get connected so that he's able to come up here. He's professor of economics at the Princeton University in New York and director of Bentham Center for Finance. His work on monetary economics, financial stability, and digital money is well established and shaped the policy debate on both sides of the Atlantic. His recent book, The Resilient Society, has in particular triggered policy discussions. Markus has a presentation and gives a speech, and I hope we have a little bit of time in order to have some questions with Markus and with you immediately thereafter. Markus, the floor is yours.
Thanks a lot. It's a pleasure to be here with you and talk to you from an academic perspective. I would like to talk about the digital money and resilience and all its connection with sovereignty. So when you look at the current world order, the world is changing. We live in a world of radical disruptions. The old world order was characterized by stability, rule-based, multilateral. There was a unipolar world since the fall of the Berlin Wall, and a US hegemon, which provided a lot of public goods, like lender of last resort features at a global scale, free seaways, and so forth, and had a long-term focus, smoothing out short-term disruptions. And the whole thing, the underpinning of this world order, were some huge interdependencies. We were dependent on each other, and there was a balance of choke points. Now we go to a new world order. It's transactional, it's bilateral, and it's bipolar, multipolar, we don't know yet, but it's characterized by a US-China rivalry. And everybody is maximizing choke points. I would like to have a choke point against you. You will have to have a choke point against me. And so we are geopolitical in our thinking. So that's one big disruption. We have to optimize our monetary thinking. The second big disruption is digitalization. And Madame Lagarde was talking about this. But there's two components to it. One is, of course, artificial intelligence. We'll have AI agents paying to each other. We will probably have some legal entities paying to each other, artificial intelligence legal entities. And digital money is crowding out cash, the only public money the central bank essentially has towards that. Now that's some challenges we have to face. And the question is, how do we face these challenges at the times of disruptions? What is our approach? Do we want to focus on a resilience approach or some robustness approach? So what's the resilience approach? What's the difference between resilience and robustness or rigidity? If you're resilient, you take on some risks from which you can bounce back. You test waters, and if something goes wrong, you have the ability to pivot and such that you can bounce back. So you take risks from which you think you can bounce back, but you avoid risks from which you're trapped or hit a tipping point. So that's essentially, rather than thinking about risk, taking or not taking, you think about what type of risk can I take, what structure can I build up, such that I can actually, some risk from which I can bounce back, I can experiment and take also the opportunities. Other risk from which I'm stuck, I actually will not take it all. And often I compare this with a reed. In a reed is like when the wind comes, it bounces back and forth all the time, and you think it's very weak because it's so volatile. And actually volatility is not a good measure of risk. Okay, something which is very volatile but can bounce back is actually not so risky. So the alternative to the resilience approach, which many people take, is the robustness approach. I would like to have it robust to whatever comes. So I resist change. I maintain the status quo. And I don't react much. It's not the reaction which I optimize, but I just want to be rigid. I want to keep it. It's a little bit like the oak. So it's very rigid and will not move as times are changing. But at the world where times are changing radically, like a new world order or digitalization, this is not feasible. The robustness approach is not feasible. So we have to be agile. We have to be movable and like a reed rather than staying rigid like an oak. And of course, there's a famous fable in French where the reed and the oak, they talk to each other. And the oak is very majestic, saying, oh, I will be rigid, I will not bound when the wind comes. But the reed comes back and forth, it looks like the weak with high volatility. But at the end of the day, there comes a hurricane. The oak falls over, can't come back, and the reed bounces back. And the reed talks to the oak. I bend, I bow, but I don't break. And that's essentially what we need as also in the monetary system. So a lack of resilience, if you're not resilient, if your position, if your monetary system, the payment system and all elements with it is not resilient, you undermine your sovereignty. And I would like to highlight 4 elements of sovereignty. The first one is monetary sovereignty, which for a central bank essentially is the ability to stimulate the economy or slow down the economy. If the economy overheats, you would like to slow it down. If it's too slow, if there is too little productivity and too little production going on, you would like to speed it up. Okay? And for this, you have to maintain that the euro stays the unit of account. So the main currency, everything is done and counted in euros rather than US stablecoins. So the monetary sovereignty is a big sovereignty concept. The second digital sovereignty concept is the digital sovereignty. The ability to operate, audit, and if necessary, switch off certain moves of value. So that depends very much how is the back rail organized. Are there choke points? Do you control your own digital sovereignty or not? Are you subject to cybersecurity risk? That's all about digital sovereignty. Of course, it's easier if things are done in your currency, but it's all about the backbone, about the payment systems and the backbone of the payment systems. And the back rail should not be foreign. The third sovereignty concept is financial sovereignty. That's the ability of domestic households and firms to access credit in domestic governed terms. It should not depend how foreign banks will perform or not, whether they can drag down your economy or not. And you should also not lose your credit allocation ability to big tech platforms to foreigners. You have to have your own sovereignty in this dimension. And the fourth one I would call privacy sovereignty. You should also be able to protect the privacy of your own citizens, your European citizens. So all of these four sovereignty concepts, I would like to walk through them one by one and see how the resilience concept might actually be helpful to develop a better sovereignty for Europe. So what's monetary sovereignty? Monetary sovereignty is the monetary policy to manage the business cycle. So as I said, if the economy slows down, you can cut interest rates, you can stimulate the economy. If the economy overheats, you can slow it down. So that's a key task of the central bank, of the ECB. And the question is, what does it depend on? And remember, probably from your high school or your studies, the role of money is unit of account, store of value, medium of exchange. If you're in payments, you're mostly on medium of exchange focused. But unit of account, which unit is money and value measured? Is it measured in euros, in dollars, or some other currency? Are wages paid in dollars or in euros and so forth? If you're dollarized, if you become dollarized, it's not done in euros anymore. So the unit of account is the key role for that. And you want to protect the unit of account. And the second component of the monetary sovereignty is the seigniorage. Of course, if you print extra money, you get some seigniorage. That comes from the store of value aspect. People would like to hold your currency, and hence you can issue some currency they would like to hold. And from this, you can generate some seigniorage as a government or as a central bank that ultimately belongs to the citizens or the government. And you can also do some financial repression. If the governments are overly indebted, typically what happens, there will be financial repression. That gives the government some seigniorage and gives essentially some sovereignty. Whether we want this or not, it's a form of tax. That's a different question, but it's most likely coming given the high debt levels we are experiencing. Now, if you have monetary sovereignty, you would like to have a uniform currency. You would like to have that in the whole euro area, there's the same currency used. But we don't have one issue of the currency. We have many issuers. So if you just think about it, who issues euros? The ECB issues cash. It issues potentially in the future digital euro. But most of our money is issued by private banks. Your demand deposits, that's essentially issued by various private banks. But it's all in one unit of account, that in the euro. So the inside money, as it's called in academic terms, or checking accounts, that's all unified in one unified settlement asset. At the end of the day, it will be settled in euros. So if you have very programmable money, it might not be the same because it's a euro conditional on certain events. And that's essentially programmable money. It's not an unconditional euro. But if you're programmable wallets, what's in the wallet is still a unit of the euro. So if you have very special purpose money, it divides the unity of the currency. So why do we want this uniformity of money? And I've written for the European Parliament a report with Jean-Pierre Landau earlier on this several years ago. It's, of course, you would like to, if there's a common currency, we can compare everything much more easily. That increases competition. That's good for the citizens. So that's easier in a digital world anyway to compare things, but we will face in the digital world a lot of price discrimination. And so it's very important that there's actually a common benchmark, a common currency to compare it with. You also would like to eliminate exchange rate risk if you have many currencies, or redenomination risk. We saw in the euro crisis, it was suddenly, you know, a Greek euro was not the same as the German euro. We don't want this. We want uniformity of a 1 euro across the euro area. And we also would like to have, there are no so-called lemons problems, so there's no asymmetric information. Some people know more about the value of a particular currency than the others. But as I said, there is, through the digital world and through stable coins, there might be some digital dollarizations. We might do a lot of the online aspects, a lot of the digital world, all the AI payments might happen more in stable coins, which to 99% are US dollars. So we might have digital currency areas where, you know, like in the euro area, we might pay day-to-day things in euros, but everything digital from AI agent to AI agent might be done in dollars. It might be better if everything is done in euros. And of course, there's also cross-border transactions. We have to keep in mind of this as well. Thanks. Now, this was the monetary sovereignty. What's about digital sovereignty? Thanks. So payment systems and resilience and robustness itself are public goods. No, you want to provide something. And you also would like to, if there's something going wrong, it will lead to a cascade of other problems. Okay, so you would like to have a lot of investment, a lot of stability built in. And typically the private sector is underinvesting in this because the benefits are not occurring to the provider of the payment system. So you need the public sector to provide enough investment on cybersecurity and other things because any payment system will become systemic. There will be some new systemic risk coming from cyber issues and interoperability aspects. So what you need a system which is a back rail. You have a lot of security and cybersecurity going on. But you also need, ultimately, if there's a huge attack, just imagine a military cyber attack, that you can fall back on cash. Okay? So cash ultimately is the safest element. So even if the digital world is disrupted because of some cyber attack, ultimate resilience comes from cash then. So you have to be able to scale up cash again very quickly if the need becomes true. So in a sense, I call this the payment service of last resort. So cash is the payment service of last resort, but also on the digital space, there will be the private sector will underinvest in the safety, and that's why you can regulate this, or you can actually provide some back rail on your own. Now the other thing is, the private sector might have an incentive to make the system less interoperable than the public sector would do, or the general public would like to have it. So private platforms, they might have an incentive to keep it separate and extract some rents from this. And so for this, you need some force to say we need more interoperability. That can come through regulation, but can also come by providing some outside option, like the digital euro. If you say if the private sector is too fragmented, you can always go to a more broader element like the digital euro, and the digital euro is then a threat to the private sector. Okay? So CBDC, like the digital euro, acts as a catalyst for the private sector to coordinate. So if you think about the European Payment Initiative, it's a private initiative to coordinate, but it doesn't really have the momentum to really push it. But the threat of the digital euro pushes it forward that the private sector will go further in interoperability. Okay? So whether the digital euro will be successful or not does not depend whether everybody is using it. It is also successful if it's purely a threat to the private sector to make themselves more efficient and more interoperable. Okay? So one should, when you evaluate the digital euro ultimately, it is also thinking about what we call in economics out of equilibrium. So it doesn't occur in reality, but the fact that it's there and is a threat changes the private actors' play. So what is essentially then the architecture, the principal architecture is like some tiered resilience. So the challenge is you would like to have resilience, but you also would like to have some innovation. And for innovation, I would like to have the private sector because the private sector innovates more. So as I said, as a layer 0, you would like to have cash. If things really go sour because there's huge cyber attack, might be military nature or some other nature, You have cash as a fallback option. That's the ultimate resilience. And we need that ultimately down the road. But then you have a layer one, is like a public back rail, where essentially you have certain back rail is really provided by the public sector, by the ECB, to have maximum resilience in these elements. But on top of it, then there's the private digital money. Private digital money, fintechs, banks, and wallets, and everything can go on it. And that's where the innovation will happen at a large extent. But they have some, deposit insurance, and can go back if something goes wrong. Then there's the public sector. So it's always a public-private partnership. Money has a huge component of public elements to it. So it's not possible to make everything private. And India, is one example where you see this in very detail. Let me jump a little bit faster, otherwise I run out of time. So the third one is, and we talked about this, is financial sovereignty. If something goes wrong in some other banking sector across the world, do you want that your own economy tanks as well? Because everybody who provides credit is not providing credit anymore? Or do you want to be subject to foreign sanctions or credit card allocations or credit allocations because certain big tech companies have some problems, technical problems or other problems? And for this, you would like to have financial sovereignty. And as an exchange, if you have domestic banks, you can also bail them out. I'm not proposing we should bail them out, but you can provide some liquidity as a lender of last resort of this. But that's part of your sovereignty. You can decide this bank has liquidity problems, but no solvency problems. We can do the lender of last resort. The other bank has solvency problems. We don't bail out. But it's your sovereignty to decide this, not a foreign government to decide that. And so the power to exclude, you can also exclude somebody from the monetary system if you want to. It's in your hands, not in somebody else's government's hands. Finally, privacy. Privacy, I think, is something important. It's something which citizens value, and it should be in the hands of Europe. And the question is, why do people like privacy? One is you inherently want to keep it private. But you might also like to have some privacy because otherwise others take advantage of you. They might do some price discrimination against you. And if you have some privacy, they can't do this to the same extent. And it might also, sometimes you might like some privacy as a person, as a citizen, because you can take advantage of others. Okay? That's not such a good thing, but you might want that. But privacy is important to keep in mind. Now, in general, essentially, you have three policy levers for the payment system, or how to design a ledger. You can regulate if it's a private ledger, or you can run it as a government on your own, as a public ledger, or just keep it as an outside threat. So you have a private ledger, but then you have a public one. The public one is an outside option, and if the outside option is very good, the private one has to compete with that. And competition is an alternative to regulation, or can also have a healthy combination of the two. And what are the three decision variables? There's three aspects you have to keep in mind. One is interoperability. How easy can I switch from one ledger payment system to another payment system? What are the elasticities of switching between, let's say, two private payment systems, let's say Alipay and WeChat Pay in China? Or what are the interoperabilities between the CBDC, the digital euro, and the private payment systems? How easily can I switch? I can regulate that. And then the question is, how much do I want to link the payment ledger with other programmable ledgers? Do you want to link it to some credit ledgers, some big tech ledgers and platforms? Can I, also connect it to some supply chain platforms like Industry 4.0? There will be perhaps an automotive platform where every little screw will be paid, and this as it goes across the auto industry. And essentially, the question, can you link all the payments to this ledger as well? And then there's the privacy. That's another component. Now let me say, if I just look at CBDC, so there are two ways you can, for example, set up the CBDC or the digital euro. You can set it up very separately and say, okay, this protects privacy. It will be a totally totally digital money provided by the ECB, and nobody can link it to essentially some credit system and other things because it's totally private. Or you can make it a smart, interoperable, and interconnected CBDC ledger. Okay? Then it essentially means you have to give up some privacy because it has to be interlinked. And with Jonathan Payne, my colleague at Princeton, we pointed out, and I don't have the time to go into this, I'm already negative time, sorry. You can either have perfect credit, so there's a lot of interoperability across payment systems, so very little rent extraction from the payment system because you can easily switch from one payment system to another payment system. Or you want to have perfect payment systems, or you want to link it to the credit system, and if you link it to the credit system, you can have perfect credit arrangements. Or the third thing you can have is perfect privacy. And what we show is essentially you can only have 2 of the 3. Okay? You can't have all 3 desired features. So you can either have perfect credit by linking everything to the credit ledger, and the payment ledger and credit ledgers are interlinked, or you have perfect payments. You make a lot of interoperability, and so you can switch easily from one payment system to another payment system, or you make perfect privacy. And the way you set up the CBDC decides already where you are, which of the 2 you favor compared to the third one. Let me skip this, given my time constraints. So let me conclude. We live in a world of disruptions in geopolitical terms, but also in technological terms. And it's an exciting world to live in. But it also is a world where we have to rethink how to do that. Focusing on stability, which Europeans like a lot, bouncing back to status quo, maintaining the status quo is not an option. And robustness is not an option. We have to be in a world where we're agile and adjust to the new world all the time. We need some resilience approach, like the reed rather than an oak. And I outlined 4 levels of sovereignty, which is important for Europe, but for any other nation across the world. Monetary sovereignty, be able to manage your business cycle, speed up the economy, slow it down. Digital sovereignty, minimize cyber risk and other aspects. Financial sovereignty, that the credit given in your jurisdiction is also in your control. And then privacy for your citizens. I think that the future is, of course, as it is now, a cooperation between the public sector and the private sector. But it's a tiered resilience concept, but maintaining the uniformity of currency and having cash as an ultimate resilience fallback. And at the end, I alluded to, because of time constraints very briefly, to the payment credit privacy trilemma. There are 3 things you would like to have, but you can only have 2. So you have to make a policymaker has to make a choice, which 2 they would like to have. Thanks a lot.
Thank you very much, Markus. Thank you very much, Markus. That was very enlightening. And with the president starting and with Markus now jumping also for tactical constraint, we have a broad range of topics, starting with the president, the high level, setting the stage with policy messages, and Markus now going into the deep dive of the academic perspective. The next highlight is approaching. We have now the policy panel that is chaired by Piero Cipollone, our board member in charge for all that we are talking now today. And he's joined by high-level speakers, namely Valdis Dombrovskis, Commissioner for Economy and Productivity and Commissioner for Implementation and Simplification from the European Commission, Kyriakos Pyrakakis, President of the Eurogroup, he will be joining remotely, and Minister of Economy and Finance from Greece, Verena Ross, Chair of the European Securities and Markets Authority, ESMA, and Silvia Maria Rovere, the Chairwoman of Poste Italiane. With that, I hand over to you, Piero, and the panelists, please come to the stage. Thank you.
I'm trying to understand. Good morning, Valdis. Good morning again, once again. Good morning again. So, good morning, everyone. The sun is shining on Frankfurt, which is already a good news. The second good news is that Germany won 7-1 with the big satisfaction of my friend Burkhard. And we had two great speeches, one from the president, one from Professor Brunnermeier. So this first panel could not begin under better auspices. So it's a tall bar, guys, but I'm sure we will make it. So I had long introductory remarks, but I think I'm going to skip it and introduce this panel in a simple way. Both the president and Professor Brunnermeier have clearly stated that we are facing a new age. Digitalization is changing payments and, more broadly, finance. And the question is, what do we want to do with that as a Europeans? Do we want to take this opportunity to possibly overcome many of the obstacles that have held our financial system a little bit in the back, not leading the world? Do we want to take this opportunity or not? The alternative is very simple. Do we want to be actor of this transformation, or we want to sit in the gallery and watch it? That's the simple question. So if we answer yes to this first question, that we want to actually be protagonists of this first revolution, important revolution, the next question is, what needs to be done? From our point of view, the ECB, we have been very clear so far. There are three things that we need to do. There is a role for the central bank, there is a role for the market, and there is a role for the regulators. What is the role of the central bank? Well, the president was very explicit. Do your job and do it well. How do we do our job? We issue money. We have been issuing money for, decades. But the world is changing, and we need to think ahead and how to issue a money that is fit for this new revolution. And we are doing both at the retail and the wholesale level. But for while it's fundamental also for the reason that Professor Brunnermeier was saying about the importance of the retail, for financial market, what is crucial is also the retail, I would say, is essential, the retail. So as the financial market move and start to exploit DLTs, we need to provide a cash leg to this transaction. We need to have a money that is fit to pay on DLT. And therefore, we need to think, how do we provide liquidity, central bank money on this space? And that's our project, Appia and Pontes. That's what we are doing. We are providing a cash leg for transactions that occur on DLT. Without it, we don't think, without central bank money, we think this space will never be, this market will never develop. By using central bank money, we think that this market will grow, providing space also for private solutions to flourish. So as is today, financial markets do not rely only on central bank money. They also rely on commercial bank money. The same will happen tomorrow, but we need to expand this market. And the centrality of central bank money in this is crucial. So this is our role, and we are doing it. Next, come to the market. Market have to invest and believe in this transaction. Let's be clear. Up to today, there is a lot of talk, but the action is not that big. As far as I know, there are, around the world, 30 billion of assets tokenized. This is peanuts. We need to step up quickly. So there is a role for banks. to start exploring tokenized deposit. There is also a role for other players to start to issue asset on DLT, if we want to make it. So market need to invest. But there is one third dimension that is very important, which is the regulator. Markets are not investing because they say we need clarity. For example, in Europe, we do not have one single definition of what a tokenized deposit is. So, you know, before investing, you want to know what is the field you are playing in. So we need to do something about this. Also, when it comes to the concept of what is a tokenized asset, what is the regulation around it, we are still lacking an homogeneous regulation across Europe. Actually, what we are seeing is already that some jurisdictions are trying to define their own regulation. So we risk to fragment again at the legislative level, also in this new market. We should avoid that. So we push for, we ask for the regulator to give Europe a uniform regulation of digital asset. Last, there is also a role for member states. Sovereign bonds are essential for this market. So it's important that, you know, debt manager that manage public debt experiment on this field. This would create a base for the market to expand. So those are our view at the ECB, and I try to set a little bit the stage. And to discuss this topic, we have a great panel today. Jürgen already presented it, so no need for me to enter again in the presentation. I would jump immediately on the discussion. And the rule of the game are the following. We will first have one single question for every one of you guys to answer, and then 5 minutes each, 5 to 6 minutes. And then we will go with our second round of questions that is addressed specifically to each one. So the basic question, the initial basic question is, what are the main benefits of and the opportunities that digital finance can deliver for Europe? And what is it transformational about it? And how it can help Europe to finally achieve the saving investment union that we need to finance the many ideas, a good project that we have in Europe. Let me start with Valdis. Valdis, please.
Yes, thank you, Piero. Good morning, everyone. It's a pleasure to be here in Frankfurt. Well, I think digital finance offers a real opportunity to strengthen Europe's economic foundations. We face massive investment needs on everything from digitalization itself to defense, and integrating European capital markets to better channel the high household savings which we have towards productive investments will be essential in this regard in the years ahead. And this is the overarching objective of our Savings and Investments Union strategy. So what we believe digital finance here can do, it can radically reduce friction / distribution costs, lower entry barriers. And basically with this it can shift the European economic model from one where European citizens' savings are currently being held in cash deposits in banks, more towards active long-term investing, participating in actually addressing Europe's investment needs and Europe's future growth. So this is one of the elements in our savings and investments union. So what we put also like citizen first, and through digital finance we can lower also intermediation costs to improve net returns, and also make smaller balance accounts, so smaller savers, kind of financially or economically viable. So what we therefore must focus when we are now developing this digital finance framework is simplicity and accessibility for citizens, to prevent digital exclusion, to make sure that everyone can find its place in this savings and investments union. One element I would highlight in this regard, which we have put forward as a recommendation already last year, is savings and investments account. And again, features like digital onboarding, mobile platforms, interoperable infrastructure can dramatically reduce barriers for first-time savers and first-time investors to enter into this market, and make it, so to say, a habit to invest in those markets. And also when we digitalize and automate tax reporting and payment processes around this, that also removes a substantial barrier, so creating a completely frictionless user experience. So that's maybe a few points from my side to start.
Thank you, Valdis. So why don't you, I have an order that is an alphabetical order, but I don't think it's the most appropriate thing. So why don't we jump to Silvia? So Silvia, from your point of view, how would you answer to the first question I posed?
First of all, thanks for the invitation. But, well, as you said, we are in the middle of digital revolution, which is a comprehensive transformation on our financial system and our society. And we saw, from our point of view, a great acceleration of this during the COVID pandemic, because people became used to digital solution, not only for e-commerce and delivery, but also they start to use video calls, mobile apps for key life decisions, including investments. At Poste Italiane, we witnessed this transformation firsthand, because we are sort of last mile between citizen and financial institution. And we started to provide digital identities. It was necessary to book vaccine at the COVID pandemic. And we so far issued 30 million digital identities, which represent a sort of 72 market share. I'm starting from the digital identity because I think that this is a sort of early step of digital citizenship. But then, thanks to this general adoption of digital solution, we started to offer digital services to our clients through a common platform, which is a gate of access to all our services: banking, insurance, telecom, energy, logistics. And we understand that digital is becoming a new standard of interaction between citizens and financial institutions. I think that we are collectively building a sort of digital investment capacity for our citizens. And this is truly transformational, because it's a first step to really start to channel private savings to more productive investment. On this, I will flag 3 points of attention. The first one is that digitalization will bring growing disintermediation. People will be able to manage their personal finance almost on autopilot. I mean that the risk is that financial services are become like travel agent, redundant by technology. To remain relevant, I think they either transform themselves in high expert in high quality services, or become sort of, let's say, holistic partner for the well-being of the family of the citizen. The second point that I want to highlight is that fee and remuneration structure will be completely reshaped because systems become more automated and investment decisions are more AI-driven. This is a huge challenge for the asset management industry and the banking system. The third point is transparency will increase dramatically. Clients will be able to track every single euro they invest. They will be able to compare. They will be able to benchmark in real time. Again, this will be a huge challenge for asset management and private banking. Finally, the tokenization will open a door to micro-investment and fractional ownership of assets and returns. So to answer, in conclusion, to answer your question, I believe that digital finance will help you to mobilize savings, but to make the most of the digital finance potential, I think we need to unify cross-border instruments, we need to pool resources, and move beyond local fragmentation. That was exactly the message that Christine Lagarde delivered so far.
Thank you, Silvia. Thank you very much. Maybe we should be kind to Kyriakos that is looking at us from the distance. So Kyriakos, why don't you go next?
Good morning from Athens, and delighted to be joining you, albeit digitally, even though, as you mentioned, Piero, it's sunny in Frankfurt, so I wish I were there with you. But let me begin by saying that this is an extremely pertinent topic. And digitization overall, and I agree with Silvia, is a broader trend, a broader change that's taking place in our society. And it's quite important that you started from digital identities. Because overall, the way states and economic systems are serving citizens is generally being transformed. So this is a process. And within that process, the opportunity layer and the threat layer, to a very large extent, coincide. And I would begin by stressing this, that as the world is becoming digital, it's extremely important to participate in this change overall, in this transformation of the system, because if you don't do so, there is a great opportunity cost and a great cost that will end up being prevalent at the very end of this transformation process. That would be my first point. The second one is that within this process, we're also seeing what other places, other jurisdictions, other states are doing and how they are transforming their own systems. And it's quite important, I think, to see what's happening on the other side of the Atlantic, where the choice, the core policy choice, was not to create a digital dollar, but to create an overall private innovation around the system through the Genius Act in the American case, which is a broader, I would say, part of the American policy agenda. In our case, we're opting for a different strategy. And this strategy is dual in nature, because on the one hand, the core element of the strategy is to have a very strong public infrastructure, the digital euro, and then create and allow for private innovation to occur around this strong public infrastructure through the MiCA regulation and through our overall approach. Now, on the latter part, we're beginning from a disadvantage. The disadvantage is that 95% of stable coins are dollar-backed, less than 1% are euro-backed at the moment. So our regulatory framework is allowing and enabling for this private innovation to happen, but by definition and more commensurate with our culture as a union, we wanted and we opted to develop a very strong public infrastructure, and this is the choice behind the digital euro. Now, overall, I don't think, especially in this group of people, to preach the benefits of digitization of retail. Let me just say, since I'm connecting from Athens, that the fact that my country, for instance, has managed to produce sustainable budget surpluses lies to a very large extent as an outcome of the decision to digitize our payments. And a simple connection of the digitization of payments in Greece, of a POS machine with a small SME, worked miracles for us to be able to have both primary and headline surpluses. So overall, trust, digitization of retail, all of those elements play a huge role in our overall proper economic management. Plus, culturally, if you look at the younger generations, for them, currency is by definition digital. So for us as Europeans, the core decision lies in the strategic elements of the question, specifically whether we would have done this as a private or as a public infrastructural decision. And I think it's quite wise on behalf of the ECB and of its president that we decided to move ahead with the Digital Euro project as a publicly owned and publicly deployed public infrastructure. Cybersecurity also is going to be an increasing element in the equation. We're all seeing the recent developments in the AI sphere, in the AI field. The discussion today lies with Anthropic Mythos, but in 3 months, 4 months, 6 months, this discussion will continuously evolve. And if we look solely at one LLM, we're going to be looking at the tree and not at the forest. So it's very pertinent and very important that we own the infrastructure on that field. It's not only an economic question, it's also a sovereignty question. And it's also a question about overall deploying innovations on top of that infrastructure. And my final point to conclude would be that tokenization and DLTs at the wholesale layer are also equally important because they will allow for a significant ecosystem of applications and innovations to also flourish should we move ahead with the deployment of the digital euro according to the time frame. I believe that we will. The European Parliament is moving ahead fast. We should move ahead with the trilogue as soon as possible, and the time frame of 2029 should be an overall commitment of all governments in Europe, of European ministers, of the European Parliament, and certainly of the Eurogroup. This is an existential area also for the deployment of the SIU, the Savings and Investment Union. Overall, this project is a game changer, and this is why it merits our full support.
Thank you, Kyriakos. And yeah, indeed. So last but not least, we have the European regulator. So, Verena, what's your point of view from this?
Thank you very much, Piero, and thank you very much for having me here. I think I can very much build on what has already been said. I think digital finance and how the digitalization is changing all of our worlds, but also specifically the financial markets is clearly key and is happening very fast. I think it brings greater convenience to consumers, to investors. It brings greater efficiency for market participants, and overall can really help us to increase speed, lower cost, and ultimately also create, by nature, a much more cross-border European financial market. So from that perspective, I think it's very, very important that we progress in creating the environment for that digital finance to really scale and build up. Valdis rightly linked it also to the Savings and Investment Union. It's ultimately about boosting the participation of EU consumers, of EU citizens in financial markets, moving household savings from bank accounts, at least partially, into the investment in capital market. That will bring benefits ultimately not only to the citizens and the investors themselves, because long-term investment in capital market is clearly been shown to bring longer-term benefits, but also to the growth of economies and our financing needs, because it means that we can actually use some of those savings that we have in Europe productively for our companies and our growth. So I think from that perspective, it's clear that we already, if we look around, we see innovative financial platforms actually being used quite a lot by retail investors, particularly if you look at the young adult population. You see that taking off in some countries quite significantly. Also, we see that they are being a bit more disconcerting as to what they want to invest in, not just speculating day-to-day in crypto assets, but actually also looking at some of the other instruments that are there that might bring them benefits in the medium and long term. So ETFs, shares, all of those kind of things. And what we also see with the digitalization is actually social media and AI playing a bigger role for investors. And Sylvia mentioned this already. It's also about how customers, how clients get information, how they compare different products and different possibilities that they have. So all of this is really shaping investor behavior. And from the regulatory perspective, from the ESMA perspective, it's really about trying to make sure that we have a regulatory regime when it comes to investor protection, when it comes to orderly markets, that is adapted to that and that really can work in this new digital world and support the digitalization that can bring a lot of the benefits I mentioned earlier.
Thank you. So I am impressed by the ability to keep track of the time. Our speaker have been orthodox on that. We have 30, we have almost, yeah, thank you. So we have 32 minutes, which means that we can have a second round of questions. And if our speaker will be diligent as they've been so far, we would have the possibility to have some questions from the floor. So let's move to the second round. I will start back with Kyriakos. Kyriakos, I want to go back to this issue that I was mentioning before, right? How can we make sure that we do not refragment at the European level the legislation? And so what can we do to strengthen the coordination of the national digital finance and foster a greater regulatory convergence across Europe? I'm asking this to you because you have been very forceful, I would say, in putting this issue of digital finance at the center of the work of the Eurogroup. And I mean, I've been involved myself, and so I have seen many progress. First of all, in the understanding of what we were talking about, and I see a clear path, political path there. But I would like to hear your point of view on this.
Well, Piero, I think you're absolutely spot on with regards to what we're trying to achieve, because the first step is exactly agreeing upon what it is exactly that one is trying to achieve. What is the common vocabulary that you're trying to develop? Because at the end of the day, digital finance is not only a regulatory file, it is part of the competitiveness agenda of Europe, because it touches payments, it touches capital markets, savings, bank funding, stable coins, tokenization, cybersecurity, the international role of the euro, and the sovereignty element at the epicenter of the international role of the euro. So the first point that one should try to achieve is a common understanding, a common strategic direction among euro area governments. This is exactly what we have been trying to achieve at the Eurogroup, and hopefully very soon we will be able to have a quite tangible result. We have 4 quite practical steps that I think we can make. The first one is stronger coordination of national digital finance strategies. Exactly the point, I would say, of the president as well, not to have this deviation of the strategies themselves. Member states should not develop separate approaches to tokenization, stablecoins, digital identity, fintech licensing, or supervisory sandboxes in isolation. The Eurogroup can help create this common framework of priorities so that the national initiatives reinforce each other rather than fragment the market. Second, a consistent implementation of the European rules, MICA, DORA, instant payments, open finance, and digital identity, which was mentioned before. They will only deliver their full value if they are applied in a convergent way. A regulatory arbitrage inside the single market would be the worst possible outcome. It would weaken trust, reduce scale, and undermine effectively the credibility of Europe. Third, we need this common infrastructure that we are discussing. The digital Pan-European payment solutions, interoperable identities, tokenized settlement in central bank money, cross-border data standards, all of those are part of the same architecture, and I would say they should be viewed as part of the same architecture. And fourth, we need supervision that matches the scale of the market and the scale of the ambition. Where activities are genuinely cross-border or systemic, supervision should be genuinely European. We cannot build a European digital finance market with 27 different supervisory interpretations of exactly the same activity. The key conditions are therefore clear: legal certainty, technological interoperability, supervisory convergence, cyber resilience and scale, but there is also a political condition. Europe must avoid 2 mistakes at the same time. We cannot regulate innovation out of existence, but we must not also allow strategic parts of our financial system to be built entirely on infrastructures, currencies, and standards controlled elsewhere. So to cut a long story short, this is exactly why the digital euro matters. It's not a payments project per se. It's a public anchor for Europe's digital monetary system. And around that anchor, we will create private innovation. And this is why we need to streamline this project as quickly as possible.
Thank you, Kyriakos. Very clear. So since you mentioned European regulation, why don't we go directly to the main chief of this endeavor? Verena, Kyriakos made this point, right? We need a regulation that somehow unifies the market, but at the same time we need to strike the right balance, not to stifle innovation. So what is the right mix, and what are the policies that are required to foster tokenization in Europe? Or how do you see from your point of view this trade-off on this topic?
I think it's a real challenge for all of us, and I would include Valdis and the Commission in this, the co-legislators, but also Sylvia and the market. So I think it is really something where we need collectively to find the right balance, to have broad guardrails and clear common standards that we can all sign up to, and that basically set the basis for interoperability, for interlinking the different solutions that are now coming forward. And that's because at the moment, if I see what is happening on tokenization and DLT development, you see, as you say, it's still peanuts, it's still quite small, but there are interesting projects that are happening. We have the DLT pilot regime in Europe. We've seen 6 very interesting DLT projects coming forward. 10 further ones are under discussion in the authorization process. So clearly something is happening on the ground. But where we are, I think, in danger is that all of these are kind of happening in their own walled little garden, and they can't really talk to each other. And that is, I think, one of the points where we really need to find a way collectively, public, private, I think, to move forward to create that ability to bring that together between the different DLT points, but also the DLT with the traditional financial system. Because in the end, as also the professor was saying, you need to be able to come back to your kind of cash kind of asset. But what we see, I think, is huge development and potential for tokenization. I think we are at the inflection point a bit at the moment. If you look at what's going on in the US, for example, what DTCC is currently trying to do, experimenting in some particularly liquid parts of the sector, but clearly with a potential to using all its various collateral assets in a tokenized way. I think that is really something that could change fundamentally the equation. And for that, we need to make sure that we have something in Europe as well that is creating a stable but flexible regulatory environment where we can see European alternatives emerge and become scalable cross-border. I think one other element, maybe just to add, is the whole legal certainty point. What we are seeing at the moment is that fragmentation, that when it comes to settlement certainty, insolvency, company law, people go back to national regimes. There are a number of national regimes currently being developed. And I think that is something which also Kyriakos clearly referred to, where we are in danger of refragmenting the market. And so I don't know whether we can further develop the 28th regime or something like that, that gives us an opportunity to really take that next step to also create the legal certainty and the general certainty for using these type of DLT technology in a way to really embed in the financial markets.
You mentioned the DTCC initiative to allow essentially CST to tokenize traditional assets. Is there any impediment in Europe to do the same, from your point of view, as far as you know?
So I think there are a number of aspects. At the moment, my impression is that most of the projects which are underway are very much looking at certain parts of the asset spectrum, and they are not yet, and not either in the US, to be fair, in the main frame of financial assets, equity. Some specific bonds you see, but not the kind of broad range. Is that because people just don't yet believe in it? I think it's also partly because we don't yet have the liquidity of a secondary market. So it's, experimentation on certain aspects, but to actually make it scale and make it attractive to the wider client base, I think it's more difficult. And so I think it is something which we also collectively between us, with the ECB, with your Appia project, really need to look at how can we get that scale to develop from the very interesting experiments that we are seeing. So I'm not sure there's a legal impediment as such, but it is clearly difficult, and I think we also need the amendments that are coming through now on the Settlement Finality Directive, on some of the legal regimes to make sure that that scale is really possible.
Indeed. I mean, this is a complex, this is an ecosystem. So all parts need to move in a coordinated way. Otherwise, it's difficult that, to have a full development of this market. So on this, I want to go back to Sylvia and say, because this is an ecosystem, because we need an harmonious movement of all parts in order to have the mechanism to work properly, I'm thinking from the private sector to two dimensions. One is, and you already alluded to that, what the payment providers can do to help the digitalization of the economy, but you already alluded to that. The second is, there is an educational to be done here, an educational effort to be done here, right? From the financial, so a little bit of financial education, so what the private sector can do on that. And the third dimension is, how do we can construct the supply side of this tokenization world, right? But how do we foster also the demand side? Both from, I'm thinking to retail investor, I'm thinking to SMEs. Would they be able to use this new technology to access finance, a little bit of more market finance? So what's your view on this, on these 2 points?
I will start to say that the ability to pay is a service of general interest, is a public good, and financial accessibility is a public good. So the digital euro is designed to work alongside other payment systems, but we really need to make sure that every single citizen in Europe is actually in the position to use it. And for Poste Italiane, this means that we have a clear role in what is called the last mile delivery. And this is recognized in various drafts of the legislation that is under discussion. What that means to be the last mile service provider means that we are a key direct contact between the citizen and the new currencies. And this means that we have to even enhance our attitude to the financial education that we already experimented in the past. For example, with this focus group that we host in our 14,000 offices, postal offices, or webinars that are open to everyone to enhance the financial literacy, not only clearly in the digital payment, but in all digital instruments, but we need to foster this for the digital euro adoption. During the pandemic, we started to explore this new project and opportunities, and we discovered that the correct approach is phygital, not just digital. So we give access to the new technology to our clients, both in our local and very extensive physical presence, as well with our powerful digital ecosystem. What I want to stress is that I push back the assumption that digitalization means eliminating physical presence or human touch. Is the opposite, because if we want to bridge on the digital divide, we need to stay closer to those citizens that experiment this divide. Just to give you an example, which is, in my opinion, very significant, is the Polis project that was one of the most important EU programs co-financed by private capital, Poste Italiane, and Next Generation EU funding. Through this project, which is considered one of the most important in terms of social and territorial cohesion, we decided not to close our network of postal office in the small town and village, but on the opposite, to invest on it, to bring them new life with new technology, new infrastructure, and to transform this 13,000, well, 13,000 total, 7,000 postal office in the town with fewer than 15,000 residents into public administration hubs, meaning that citizens can access passport, tax and pension certificates and services into our postal office. The project has received 800 million from the Next Generation EU funding and 400 million from Poste Italiane. You can imagine the impact to bring all the public administration services to the remote and rural area of the country. This gives the opportunity to the local community to start new business, to feel the presence of the state, and to have the same opportunity that citizens experience in the big cities. And I think there is a lesson for the digital Europe in that, because we need to ensure the same level of standard, you mentioned, Verena, before, in each country participating to the project. So each European citizen should access the digital euro with the same level of services and accessibility. To do that, as you mentioned before, I think that public administration and private companies must work together on mutual fundamental standards. We have to mitigate the risk that the extreme digitalization and can feel like, what I mean is that we need that we have an approach to the digitalization that is close to what the Nobel Prize laureate Dana Acemoglu mentioned as a human-centered approach. I think that the adoption of digital Europe should be accessible and reassuring for everyone. Otherwise, we will not succeed.
Thank you, Silvia. No, this is a key point, not to make sure that no one is left behind of the digitalization process as a whole and the payment system. In particular, an aging society, a more diverse society, will require from us to think carefully about this. Valdis, for you, the last two questions. So our two speakers had two key central messages, right? Professor Brunnermeier said, you guys need autonomy, strategic autonomy. And we are responding to that through the digital euro. So my first question to you is, how do you see the role of the digital euro in fostering our strategic autonomy? And the second point I have to you, the second question is what the president was saying, right? She closed her speech by saying the ultimate prize here is the role, the international role of the euro. So how digital finance can help us to have a stronger role of the euro in the international arena? Valdis, to you.
Yes, thank you, Piero. So on the first question on digital euro indeed can help us to strengthen the strategic autonomy, as currently our payment system is dominated by third country card providers. So by setting up a proper pan-euro payment infrastructure by the European Central Bank and building on this, we create, in a sense, our own payment systems on which we can rely and which can have straight away a pan-euro reach. And clearly, in a geopolitical situation which is more fragmented, more conflictual, it is important for us to strengthen this strategic autonomy and to move forward with this project. It also can help with actually then scaling up private sector solutions, because what the ECB would be preparing would be based on open access standards. It means private sector can build on this, and relying on the legal tender status of digital euro to scale up across the euro area, at least seamlessly. So that's, I think, two important elements. So in terms of where we are with this digital euro project, I hope we will be able to move progress. It has been a long legislative process so far, but so we're expecting a vote in the Econ Committee in European Parliament very soon, presumably 23rd of June. I would say about time, given that the rapporteur's report was published in October last year. But it still gives us a hope, as we were willing to finalize the legislative process still this year. Irish presidency is very much willing to advance it, and also I think there is a good chance that the positions of the two co-legislators, Council and European Parliament, will not be, massively different, and there, in a sense, the closer the two co-legislators are, the faster we can move on the legislative process, which then should keep our timeline of actually launching the digital euro as of 2029 realistic. So let's work on this, and from Commission side, we obviously do what we can to facilitate this process and facilitate the work of co-legislators. There is another important aspect I would mention in a context of this work on digital euro, and Professor Brunnermeier also touched upon this. It's a role of cash, as he was saying, as ensuring ultimate resilience. But also I would say in a context of digital euro, debunking certain conspiracy theories. So that's why in parallel with a proposal for digital euro, we also put forward a proposal on strengthening the legal tender status of cash, kind of tasking euro area member states to ensure sufficient availability and sufficient acceptance of euro cash so that it can fulfill its legal tender function. So it's important that also this legislative file moves in parallel with digital euro. And then on the international role of the euro, indeed, we now are working to advance this process, looking across different areas. So the use of euro as a reserve currency, where we already are a second largest currency in international payments, in trade, in energy invoicing, in other elements. So in a sense, looking what are the friction points, what can help us to debunk it, and again, advancing with the digital euro. Also, many colleagues were mentioning with tokenization of deposits and elements against this, again, can help reduce frictions on cross-border payments, on remittances, on micropayments, and so on and so forth. This is obviously another important work stream we are pursuing right now, and we believe that we have a good foundation for this, because in a current world, having stability, predictability, respect for a rule of law, strong institutions, and so I think it all helps us with a good basis on which we can build actually to promote this international role of the euro. And again, a digital euro can play a role also there. I know that the approach we are taking is a bit cautious, in a sense we are not opening digital euro to entire world, also respecting other countries' monetary sovereignty, but entering into agreements with the third countries, we can make digital euro accessible also to the third countries or non-euro area countries, and this certainly will also help with the international role of the euro.
Thank you, Valdis. So we have 6 minutes left. So I am ready to take some questions from the floor. I mean, we had a rich discussion. I hope someone has. Please, sir. Do we have a mic?
Yes, we do. No, we do.
It's coming.
I think it's also broadcast.
Can you introduce yourself?
Thank you. Mauro Pernigo, Intesa Sanpaolo. I am in the SWIFT board. I am a previous European Central Bank drafting Target 2 securities, and I've been one of the first working recently on the wholesale digital euro, so I'm quite here. My question is more to politics rather than Mr. Cipollone, because we know very well the project of the digital euro, both wholesale and retail, and we know communication and data enough, so we have many questions to pose on this. My question is more on legislators, let's say in this way. In this moment, we have a very high potential for the digital market, which is the one of the M-letter, the model law for transferable record, which could boost the value chain, the industry 4.0, and so forth. As far as I know, the single European countries are moving independently in recognizing the legal value of the transferable record once digitized, and so we have not an homogeneous path which might bring to have new types of security on a digital secondary market, boosting this market. And now that we have Pontes, we are ready to make it in reality. And so the question is why the Commission, the Parliament, which is always very generous in giving regulation for everything, didn't address some suggestion or policy in order to have all the countries in the EU recognizing the M-letter in a short time, so to boost the market. Mr. Cipollone can do his job for the money. Normally, private investors are worried about the transitory regimes, the limit to the capitalization when you go on using DLTs and so forth. But we need to have another boost from the.
If you want an answer,
policy.
I think we need to. We cannot afford one more quick question before. Please.
Thank you. Christoph Hock, Head of Tokenization Digital Assets at Union Investment. Also, over the last couple of years, heavily involved in tokenized bonds, also on the payment rails. Looking at the visionary view on tokenization, Piero, in the US, we've had most recently publication of a very comprehensive paper on Clarity Act, defining the future infrastructure rails in the US,
In the UK, we've had similarly a paper issued by FCA and Bank of England on the future of tokenization. Here in Europe, we have fantastic views from you, from Ms. Lagarde, also looking at Brussels, ESMA, and the European Commission. Could you imagine that really to create further sense of urgency to speed up here, that in Europe we come also with a similar visionary paper, how financial markets look like in the future? And I think this would be also helpful for real economy to really create urgency and the meaning of tokenization to further implement.
Okay.
Thank you.
So we have 2 minutes, so I think we go directly to the answer. I am the chair of the panel, so I'm not supposed to answer, but let me say that I see 2 important points in Europe. First, the sense of awareness. It seems to me that is increasing. 1 year ago, 2 years ago, I gave a speech at the Bundesbank, and nobody understood what we were talking about. In 2 years, we have done huge progress. Second, we are moving. Yeah, obviously, obvious. Ça va, Sandy. There is another important point that we need to understand that we should really leverage. We are moving in a coordinated way. You had the private sector, you had the central bank, you had the regulator and the legislator. We are all on the same page. So this is the precondition to move fast. But let me leave the floor to both Kyriakos and Valdis if they want to react quickly to this. 2 suggestions, because essentially is the same question.
I think there is a willingness and a readiness to move forward. Also, realization that the world is not staying where it is. We see rapid developments of stable coins landscape in the US. Kyriakos was mentioning the figures that 95% of those stable coins are in dollars. I had somewhere a figure 99% of them are in dollars, but in any case, it's very dominant, so we must respond. What is our answer to this? Well, to a large extent, our answer will be digital euro, and here we are taking a different track than the rest of the world, so to say. We are right now, I would say, only major economy pursuing central bank digital currency model and really advancing it and making it happen. US, to the contrary, have actually explicitly stopped it and said we focus on stable coins. But we obviously need to look also at DLT, tokenization, and elements like this. And I think there's a ECB's Pontes and API initiatives can play already an important role in this regards, because that's exactly what would help central bank money to remain at the center also of European payment ecosystem for tokenized finance and wholesale settlement. Well, what can I say from the Commission side? We are certainly willing to play our part, to move with the times. We are regularly updating our rule book and, so to say, ready to follow the developments, take in proposals from industry and see how we move forward. So what specifically can be done still in the legislative process of digital euro, that's something we are willing to facilitate, but that's for co-legislators to answer, because it's now indeed in the hands of Council and Parliament to run the legislative process.
Thank you, Val. Kyriakos, can we do something in the statement that we are about to issue on this?
And one quick word on tokenized bonds, which was the last question. I think that in the near term, we're very likely to see more pilot projects, limited scale issuances and experimentation by sovereign debt management offices across Europe. I think that's to be expected, but in reality, we should be distinguishing between technology adoption and market transformation here, because the important point is that tokenization should not be viewed primarily as a new asset class. It should be better understood as a new layer of market infrastructure. And as tokenized deposits, tokenized investment funds, and tokenized securities continue to develop, demand for high-quality collateral, I think, will naturally increase as well. And at that point, sovereign issuers will not participate simply because they wish to innovate. They will participate because the market itself will increasingly expect risk-free assets to be available in tokenized forms. So generally speaking, I think that the common approach developed at the Eurogroup, of course, under the guidance of the ECB, and this development of collectively agreed upon vocabulary helps in this direction. We need to move fast.
Thank you, Kyriakos. Verena.
Just very briefly, I think what is also important is, I mean, you were saying the US now have Clarity Act. No, they don't have the Clarity Act yet. They're even still implementing the Genius Act, which they decided. So I think we also need to be conscious that actually the legislative measures will always take some time. So you need to balance that and progress quickly and urgently on that. But at the same time, you also need to have the ability for flexibly dealing with things like no action letters or things like that, with the real cases that are coming forward, to make sure that you can actually progress on the basics of DLT experimentation and new ideas that are coming forward within the overall framework of moving forward to set the stability of the legal framework and at the same time reacting quickly as regulators and supervisors.
Thank you, Verena. So we are at the end of this panel, so let me thank, I mean, I don't dare to try to summarize, many things have been said. Let me say one thing. We are at the end of the process, the end of the legislative process on the digital euro, where the private and the public sector are not always being fully aligned, and this has had its own cost. I hope that for the digital finance package, we will stay more aligned and move faster in order to keep the little time advantage that we have now. With this, thank you again for participating. Let me thank all the panelists. They have done a great job respecting the time. And for insightful thoughts. So thank you very much. Thank you, Kyriakos, over there in Greece, and enjoy the rest of the conference.
Thank you.
Great, guys.
Grazie, Piero.
Brava. Thank you, sir. Very much.
Thank you very much, Piero. Thank you very much, panelists. It's a pity that we have to interrupt now the discussion when it's getting so crispy. But the good news is you can continue the talks, in particular also with our panelists and the other speakers. Now in the coffee break, we have a half-an-hour coffee break. We see you back at 10 to 12 sharp. The coffee is over there. Thank you very much. Hello, back after the coffee break. We had some inspiring speeches and talk from the president, academia, from the political institutions, and now we are moving towards operational and market reality, wholesale digital money, and the evolution of tokenized markets. The panel is chaired by Alexandra Hachmeister, Director General Digital Euro from the Bundesbank. She's joined by Marianne De Marchi, Chief Executive Europe and Global Securities from SWIFT, Mark Jam, Chair of the European Central Securities Depositories Association, Isabella Matteo Silago, Group Chief Economist of BNP Paribas, and last but not least, Thomas Vlassopoulos, our Director General for Market Infrastructure and Payments here at the ECB. Alexandra, please, the floor is yours. Oops.
Oops. Yeah, just. Okay, hello everyone. Welcome back after a short coffee break. I hope you feel energized. What we're doing now is going on to a different layer, I would say. I think we've heard a lot, and there are many thoughts that I've taken from this morning. How do DLT and traditional financial systems work together in the future? How do we work when it comes to fragmentation? Can we ultimately scale this market? And I think I have just the perfect panel for all of these questions. They have been quickly introduced by name, but I wanted to make one point here. I think it is a huge, it is a very special combination of expertise that I have. So what we get to do with this panel is really take a look from each and every perspective on this topic. And that means we have market structure side, market infrastructure side, we have a banking side, we have the macro level, and we have some central banks as well. But I'm only the moderator, so it's very balanced. So it's not two of us, actually. What we see, and I will, from the structure of the panel, I will follow your lead, Piero. So we'll have an introductory questions, we'll have a few rounds of questions, and we'll leave some room for you as an audience to ask us. But let me say a few comments up front, and I'll be very short on this. I think the first thing is, this is about getting it done now, right? We can talk a lot about digital finance and what we want to achieve, but ultimately, we have to design the markets, we have to think about the monetary architecture that we need, and then simply start delivering it, right? So this is the point that we're at, and we have to prove the point. And this will, and I think that goes back to the initial speeches that we have heard, will then get us to the point where, as Europe, we can work again on our own positioning. So for me, it is very important that we recognize for our panel that basically operations and infrastructure, they usually, they are the, what's called plumbing, or we're at the backstage. We're definitely not the hot topic, but we're actually moving center stage. Because if we don't get this right, there will be no market to scale. And this is what we're going to focus on this panel. And we'll go through different layers. We'll discuss technology, how it can support the SIU, what you individually think about the different potential instruments to use. And I'll kick off with a bit broader question to get us going here. And that is, I think we have acknowledged that we require a lot of transformation on the infrastructure side. And I would like to ask each of you, and I think we'll just go one by one. Could each of you share your perspective on how digital settlement assets, and that can be not only central bank money, but it can be tokenized deposits and stablecoins as well, how they are poised to reshape the financial landscape and drive innovation in capital markets? You want to give it a start, María?
Sure. Thank you, Alexandra, and thanks a lot for the invitation. I think that the future of digital finance will be really defined or linked by our ability to make all these instruments that you were talking about, so platforms, new forms of value, connect to each other in a safe and globally and at scale, basically. And I like the the expression that Verena Ross used at the inflection point. I think we're really at this inflection point. And we see that from the SWIFT perspective, we see that as a world that is shaped towards a world of multiples. You know, multiple forms of value, multiple platforms, protocols, standards, and also chains. And that's and each of them, I mean, central bank money, tokenized deposit, other regulated assets, will coexist, right? And will not necessarily converge. They each have a use case, or at least an utility for depending of use cases. What may work for retail P2P payment is definitely not suitable for wholesale settlement. So you will have these different use cases. But diversity, I would say, so diversity is good because we're going to have choices. However, without coordination, it may create fragmentation. And we've talked a lot about fragmentation previously, also with the panel chaired by Piero Cipollone. So fragmentation is an issue. And why? Because, well, liquidity can, be trapped in across different systems. You may have diverging processes. So all this increases fragmentation and potentially reduces economic integration. So I think the same principle will continue to apply that it is today, continue to apply to the digital world. We still need to have interoperability layers and trusted organization that will really try to connect the different systems, but not only the different native systems that emerge, but also with the current system that we have today and that we trust today. And as everyone has to do their job, as Piero said, well, our job has been for the last decades to do exactly this. I mean, to interoperate and to connect different worlds, different institutions, jurisdictions, infrastructures. And we are uniquely positioned to continue to do that in the digital world. And that's why, and I will stop here, that's why we have announced our two-track strategy, not only to enhance what exists today, because we have already a very efficient network that processes about the world GDP every 3 days on payments, but also on securities. So we need to improve that end to end. And we have launched that with 40 or 50 banks. We call it the scheme. But in parallel, we are building new rails, so adding to our infrastructure a DLT ledger that makes interoperable what is not interoperable. And we are starting with tokenized deposits with about 10 banks as of June, 10 international banks that have tokenized deposits that do not talk to each other. And ultimately, the settlement will continue to happen in RTGSs, in central bank money, whether on CBDCs or fiat central bank money. And that's important to preserve the two-tier system.
Okay, thank you, very clear. Mark, from the post-trade perspective, and it wasn't mentioned, but we have the extra chairman with us, so you basically bring the perspectives of all CSDs to the table. So what's your take of my question?
That's what I aim to do, Alexandra. No, good morning, everyone. It's wonderful to be here. It's very timely to be here. This may be indeed a point of inflection. It may be a point of transformation. And I say that as someone who believes that finance has been transformed precisely 3 times in its history. Actually, each time by Europeans, by the Italians with the invention of double-entry bookkeeping, by the Dutch with the invention of the joint stock limited liability company, and by the British with the invention of the telegraph. So is this going to be a fourth? It was my starting point. Now, the role of digital settlement currency is absolutely clear. I think we're probably of one mind here in saying that the wholesale central bank digital coin is an absolutely essential ingredient of making this recipe work out. And, you know, all of our members, I think, are fully behind that, signing up to APIA and so on and so forth. And that fits something that we also believe, that indeed depositories in Europe, but also globally, should be settling in central bank money wherever possible. That's what our regulation says. I'm quoting it. But there's often something of a hubris in the attitude of Europe to these questions, and that is to assume that it can be designed in advance. And, you know, it's like that joke they tell about one French civil servant who says to the other, he says, "Jacques, that's all very well in practice, but will it work in theory?" And, you know, I say this in the continent that had the internet 20 years before the internet, but then decided to administer it with the post office, and it didn't work. So we do need to acknowledge that we don't know what we don't know. And if I could give an example that's a little bit closer to home, and I think you touched on this, María. You know, we need to acknowledge that there are other forms of digital settlement asset, by which I mean the currency that is used to the common component, if you like, of value transfer in the settlement of securities and digital asset settlement. And if we look at our regulation, then this basically says, if we look at the MISP package, that yes, you could have central bank digital coin or other forms of e-money token, but that totally excludes the use of tokenized deposits, or even though personally I'm a little bit more skeptical here, stable coins. And just that simple fact alone will risk our being left behind, will mean that we cannot transform at the pace that we might otherwise transform at, because we're simply excluding certain things that may emerge from experimentation as dominant forms of digital currency. So we need to be, in my view, more open. And that, from a perspective, and you touched on this as well, María, is European competitiveness. If we stifle innovation, we also risk losing what we have, and what we have, and we complain it's fragmented, it's messed up, and there are too many CSDs and so on, but what we have is, by global standards, a deeply competitive post-trade industry. So let me leave it there, but let's have a good discussion.
Thank you. Some further food for thought for us. Isabel, as a global bank, what's your take on my question?
Sure. Well, good morning, everybody. It's a real pleasure to be here, and wonderful idea to put all of us on a panel for the different perspectives. So, first of all, let me say I agree. I agree with the inflection point characterization, and also with the fact that it's actually still very early days. And while we all see that there's a potential for very dramatic changes in the structure of the financial system, we can't really be sure which way things are going to go, and so we need to remain sort of humble and when we peer into our crystal balls and look at the future. Secondly, I think it's also an interesting stage because Europe is not late. You know, on a lot of things, you know, like, oh, Europe is behind, we need to catch up. Not the case here. Now, of course, Europe has a bit of a history of being early in some dimension and then getting distance. And, you know, the Americans like to joke that, sure, we had Mica long before Genius, but we don't have any stable coins, and they have 99% of the market cap. But never mind. So let's, you know, keeping all this in mind, you know, the way you had asked me to think about my answer to this first round was, how are we as a bank going to decide whether to give our clients, you know, stable coins or tokenized deposits? And the short answer is We're working on both because, again, we don't know, which way the system is eventually going to evolve, and we think it's important to be actively working on providing both. However, there's no doubt in my mind and the bank's mind that the tokenized deposit route is far superior, and in fact that tokenized deposits dominate stable coins for pretty much every use case you can think of, except abusing market integrity rules, which of course we're not trying to promote. So from the standpoint of preserving the two-tier money system that we have, that we know works, from the standpoint of preserving banks' capacity to generate credit, from the standpoint of preserving financial stability and market integrity, we think tokenized deposits work. So, but for that, as was already mentioned, you need an infrastructure that allows the tokenized deposits of different banks to connect, to talk to one another. Mm-hmm. That's where the wholesale digital euro is key, and so we're very excited about the imminent launch of Project Pontes. That's a really good start, and also very excited about the longer term project that APIA is. What I would say is, if we want to keep the dominance of the tokenized deposits over stable coins, we'd very much like to see Agora incorporated into APIA, Agora being the international payments leg. Right now, these two seem to be on different tracks. Obviously, cross-border payments are a big part of the use case for stable coins, according to their promoters, so that needs to be addressed. The other thing I would say is stable coins obviously are available for settlement 24/7. That's another big advantage that their proponents put forward. We would very much like to see access to central bank tokenized money, maybe not 24/7, but at least 24/5. That's what our clients who manage these cross-border payments or cross-border treasury operations would like to see. And recognizing that the official sector, even when it moves at great speed, sometimes is not as fast, we could see also a case for allowing a sort of private replication of central bank money that could be available more quickly, and there are solutions to that effect that have been developed and already up and running in the UK. So all of that to say, we'd rather stick with the existing system in tokenized form than moving to stable coins. And maybe last word on this, and it's not about wholesale, it's about retail, but just very briefly, because there was so much discussion in the earlier sessions around how the digital euro can be the European answer to stable coins. And that's true that's no argument with that. However, if we wait for 2029, maybe too late. And in the meantime, I think we shouldn't underestimate the value of the initiatives that the President Lagarde mentioned of connecting TIPS with other instant payment systems around the world. Ultimately, I think consumers are completely agnostic. They will go for whatever is most convenient. And if we have fast interconnected payment system, that will go a long way. And of course, within Europe, the private sector initiative that was mentioned by Markus earlier, Wero, which connects with private infrastructure, the different payment system, all of that seems to me we should support all this in order to preserve the sovereignty as much as we can. So let me stop here for the first round. I have a lot more thoughts, but I'm sure we'll come to them.
I think that was a very broad perspective. I'm sure you want to answer some of the questions and ideas that were put on your plate. I just realized one thing. I felt this was completely comprehensive. I think we're missing one of, I would say, the new innovators on this table, because who is sitting here is all of the institutions that have been there for a long while. And I know there are some innovators in the auditorium, so I expect some questions from you later, okay? So that we get you into the dialogue here. But now over to you, Thomas.
Yeah, thank you. And it's a pleasure to be on this panel and to host you. So I would echo a lot of what has been said, maybe with a few nuances, as you might expect here and there. I think clearly there is a role for public settlement assets and private settlement assets. It's a long-established practice, the two-tier system that you mentioned, Isabel, that Professor Brunnermeier also very clearly explained why the rationale and the logic and the need for such a two-tiered system with the central bank providing the base layer and the private sector, currently mostly commercial banks, providing the higher layer. So we need central bank money because we need an anchor in the system, and an anchor that is linking it to public trust. But clearly, and I fully agree with the point you were making, Mark, earlier, it doesn't need to be the case, and in fact it shouldn't be the case, that all transactions need to settle in central bank money. First of all, not all actors that are relevant have access to central bank money in wholesale sense. And secondly, it's also a question of efficiency. There are transactions that are not systemic. There's no reason to require that these settle in central bank money. And in fact, in the traditional world, private money is dominant quantitatively, right? There's much more private money and much more settlement happening in private money than there is in central bank money. So, and again, echoing what was said before, I think the task here is to move this forward, this two-tier system, into the tokenized world, where I think we need to make sure that we don't miss an opportunity and miss a chance is not to kind of replicate exactly the format and the structure of the traditional system, just in a different type of technology. I think we need this technology, which I would agree again with you, Mark, is transformational, opens up a host of new possibilities, and it would be a waste and a missed opportunity if we just replicate the traditional world in new rails. And there are a couple of examples where we can, I'm sure will come up in the discussion before. Where I would like to nuance a little bit what was said before about central bank money and private money is that sometimes they're portrayed as substitutes. Sometimes there is a bipolarity. I think, as I said before, central bank money is needed to instill trust. And this applies to any system, regardless of its level of maturity. But when we look at the tokenized or the digital finance space, and again, I would echo what all of you essentially said, starting from Verena Rosa's statement about the inflection point. Yes, I think we are in an inflection point in digital finance, but from a low base, right? So we are at early stages of maturity. And that means that we need some enabling factors to really allow that potential to be unlocked. And I would really see central bank money, and in fact, it's not what we see, it's also what market participants tell us. For instance, when we had the practical experiments in 2024, it was a clear signal, a clear takeaway from that experience was that markets want to settle in central bank money. So it's a clear enabler, and it allows the digital finance ecosystem to grow and to achieve scale for three main reasons, I would say. First one is that it's not only about the public trust, it's also about the institutional credibility that having the central bank engaged in this space brings. So that is a catalyst, I would say, also for private sector engagement and involvement. The second point is some private settlement assets. It doesn't hold for all private settlement assets, but for instance, stablecoins, they are limited in their ability to scale seamlessly, right? Because they need to be backed one-to-one by existing liquid assets. So if you are in an ecosystem that needs to scale up and presumably needs to scale up flexibly and rapidly, you need to have this ability of the settlement asset that underpins it also to scale up. And which you can still do with other assets, but you may end up in competing for a limited pool of safe assets. And the third point is that you need central bank money, and it came across in both your interventions, to act as the connector across private either settlement assets or to facilitate interoperability across networks and private ecosystems that are developing now a little bit in isolation and in silos. So let me stop there.
Okay, let me pick up on what you said, and that was a lot around scaling and the technological basis that we have. And I think the next question I would give to Mark and then you, Marianne, to add to that, it is a lot about, we know we have very efficient legacy systems, right? So the whole point would be, if we develop now the new world, how do we ensure that those two interact efficiently, and how do we get through the transformation? And I think you rightly made the point, we're starting at very small, and we need to get to that end where we are truly scaling. So maybe Mark, you will give it a go first. So what does that mean, the legacy systems that we have, all the players that we have in that world, and how do we get, to combine it with what we are actually all trying to achieve?
Well, the first observation, maybe, Alexandra, is it's not as small as all that. So my day job, I'm with Clearstream. We run the CSD, the European CSD based here in Frankfurt. It's the largest member of T2S by volume. We've actually issued 3.8 million securities in natively digital form, which is perhaps surprising, and they are all settling. That's all I think you confirm on T2S. But the market doesn't experience them as digital securities because they back into the pre-existing rails, and those securities are popular primarily in the structured product space, where latency at point of issuance is a critical success criterion. So the less time you spend shipping global notes around Frankfurt, the better the chance that the security closes in the money. So there's an absolutely positive business case for the market in using that form. So a lot of this is happening under the hood. The wider point is that estimates vary, as they put it, but we have, our members have somewhere between 50 and 70 trillion of assets under custody, depending on how you count them and what's European and what isn't, and so forth. So anything compared to that, as Verena Ross was saying earlier, is a drop in the ocean. And ultimately, you can transform an ocean drop by drop. It's possible. It's how mathematicians measure really big numbers. So we need to be quicker than that. But the point is that the liquidity of markets, the way portfolios are populated, the way that monetary policy works, the way that issuers tap into liquidity, all of those things require existing liquidity. And building walled gardens that are not connected with that legacy of liquidity simply won't work. They may be very pretty, but they will be the Minitels of the 21st century. So that interoperability is key. And our own belief is that you need to innovate both from outside the industry, and you need to innovate within the industry, and you need to ensure that those two worlds can come together, both in the practical sense of interoperating, working together, but also from a public policy and regulatory and prudential sense of being viewed regulated, supervised according to what they do, not the technology they happen to use to do it. So we need to be technologically neutral. The other point is that regulatory overlay post-crisis is incredibly robust. And we've set the gold standard in Europe for how CSDs should be regulated, for example. And therefore, we shouldn't kind of lower our guard and say, well, we're going to apply lower standards or experimental prudential standards, even if they are intended to be equivalent, just because people are innovating and coming from the outside. We're great supporters of the DLT pilot regime, but ultimately that needs to converge with the CSDR and other strands of regulation. So preserving that trust, that confidence in the prudential capability of Europe, especially as we enter a multipolar world where others may not be so committed to rules-based regulation. And lastly, it's about competitiveness. One of the things that we are fond of doing here in Europe is beating ourselves up. We have too many CSDs, we don't have a single market, it's all terrible. But what if I were to tell you that Europeans control around or have around 22% of the world's wealth, but that 60%, maybe a little bit less, between 50 and 60%, let us say, of all cross-border securities holdings in the world are intermediated in Europe. Okay, let that sink in. That's not, I don't want to claim this is the CSDs. It is partly the CSDs. It's also the big banks. It's also the foreign branches of the American banks. But they do it here in Europe, which I'm conveniently for my statistic defining as the EEA plus Switzerland plus the UK, but nonetheless.
Thanks for the transparency, yeah?
Well, statistics, you know.
Yeah.
So my point is that we have all that to play for. And when it comes to safety, I totally agree. I had a little remark here, Thomas, but you've got ahead of me on that. The only thing I would add in this sort of central bank money versus commercial bank money, when we come to think about digitization, is that one of the things that differentiates in today's world central bank money from commercial bank money is credit generation at point of settlement. So using credit as a means to settle, which is clearly super important for all sorts of perspectives, including prudential perspectives. One of the things that digital money, whether it's coin or whether it's tokenized deposits, have in common with central bank money is they do not provide for credit generation at point of settlement. Tokenized deposits obviously do further back in the chain. And that's something worth bearing in mind. We should be very careful with how do we provide or solve for that in the future. I don't know the answer, but it needs to be solved for because it's an incredibly important part of our settlement system in Europe, which in many ways was built by the investment banks as a buy now, pay later system. And that credit generation at point of settlement needs to be thought about.
Okay. Thank you. I love your pictures, the managers of the 21st century. We had the fourth revolution, so a few things that we will definitely remember from this panel. María, anything you want to add when you describe the initiatives that you have in terms of technological or operational challenges that you're really seeing?
Yeah, I will first, before answering really to your question, I will first bounce back on what you said. I mean, interoperability, and that it's, you know, we should not, I mean, creating new systems, so new DLT platforms is not that difficult. You have a group of very nice and smart engineers. They build your system in a few weeks, days, or whatever. So this is not the hardest part. So it's not the hardest part what we are trying to do in terms of technical challenge. However, the real challenge is coordination, governance, interoperability, and to scale it really. I mean, to onboard a large community and to make sure that what you're doing is not disconnected from the other systems and from the existing financial system that we already trust. So that's really the challenge. And this is what we're trying really to do. And we think it's not insurmountable because as a global cooperative, we've done that over the last 5 decades to facilitate integration, dialogue, cooperation, and to build a secure and trusted network. And what we're trying to do is to replicate it in the digital world. And what I would like to say is, interoperability and standards, because this at the end it's what scales innovation. Innovation cannot scale, in finance at least, if you do not have interoperability and standards. And it's not just technical issues that we'll sort it out later. It's really should be the foundations, and really to by design that we create something, we need to have that in mind. And for instance, finance usually is based on ISO standards like ISO 20022. You have the digital world that is based on other standards like ERC 20. It's not just choosing one, against another. It's to make sure that these two worlds are connected, and this is what we're trying to do on our what we call Ledger Initiative. The Ledger Initiative is not only connecting different platforms, so DLT platforms with the traditional systems. It's also interoperating, DLT platforms that do not talk to each other, and ensuring that the settlement is preserved in central bank money, but also in standards. And we have a standards platform and work with the industry that makes sure that we can bridge these two worlds of traditional finance and digital finance. This is what I wanted to add to your point.
Very good. I think let's get a bit to back to the Eurosystem perspective. And I think we've heard this morning on the two-track approach that we're going there on Pontus and Appia. And I would like to ask you, Thomas, if you could, give us an idea on how you would like to progress together with the market. You've heard quite a lot of ideas, I think, already. And give us a brief outline of where we are heading and what actually the role of the Eurosystem is in this whole thing around developing the ecosystem.
Yes, with pleasure, Alex. Maybe I can start very briefly by saying a couple of words about why we are doing this. I think the first one is what I mentioned before about central bank money in tokenized form being an enabler for the tokenized ecosystem to grow. The other point is very closely related to our mandate, right, of conducting or achieving price stability or maintaining price stability by regulating the market, calibrating the market activity in such a way. So to be able to do that, we need to have a form of central bank money also in tokenized form in case, and as we said, we are in an inflection point, the market moves in that direction. We need to have a lever to, again, calibrate the temperature of the market also in a tokenized world. Then if we move to what we are doing, and again, Piero said a few words, the president said some more. We have a program to work with the market. This is a central plank of our strategy to have a public-private partnership on this in order to develop a tokenized European financial ecosystem with central bank money at its anchor. And it's based on two complementary work streams. One is Pontes. It's the more immediate deliverable. It will go live in the course of this year, in the third quarter. And it's about linking, exactly to your point, Mark, linking the tokenized world with the traditional world. It's a bridge, as the name suggests, between market DLTs, where wholesale financial transactions in DLT will happen, a bridge to settle in central bank money in tokenized form, and then a bridge also to the target services. This is important for obvious reasons. I'd like to highlight the point that was made before about connecting tokenized deposits. So Pontes, as of the third quarter of this year, will allow tokenized deposits to be transferred from bank to bank, allowing banks to settle between each other natively in tokenized central bank money. And this is one step more than doing it with off-ramping into RTGS. And it's important because it maintains the continuity of smart contracts and tokenization. The other point I wanted to come back to, Isabel, was we hear the market very clearly. We are in close contact. We are being advised and consulted by the market. We are working from a, if you like, a kind of minimum viable products that would be launched this year to successive and staggered and gradual enhancements. And the intention is for Pontes to expand the operating hours as close as possible to what you described. I think we aim for 22.5 hours per day, 5 days a week, already in the summer of 27. Along with other smaller or equally important, actually, enhancements like ensuring settlement finality natively in the Eurosystem DLT, again, in the summer of 2027. And that is a further step before we launch a fully fledged enhanced product in mid-2028. The other part of that initiative or that program is Project Appia. And this is really, again, a public-private partnership. It goes a bit to your point, Mark, of designing. But we need to understand where we need to go. Yeah. And it's important that all relevant stakeholders swim in the same direction. It was mentioned before that you need standards. You need to get the relevant stakeholders from the official sector to the market participants, to the regulators, to work together on standards. And for that, you need to have a strategy, and you need to have a plan, and you need to have a blueprint. And that's what Appia is about. Now, Appia has also, Isabel, you mentioned before Project Agora. You're absolutely right. Appia has also a work stream, Appia Building Block 4, which is on cross-border transactions and cross-border payments. And one of the, as you know, the Eurosystem, through the participation of Banque de France, is actively involved in Project Agora. And it's one of the practical types of work that we will be conducting under Appia to develop it further. But we are open-minded, and we are looking also to other solutions with a view to orchestrating the settlement of tokenized deposits, whether that's domestically or across borders. And let me leave it at that.
I'm a bit aware of timing, but it looked a bit like, Isabel, you wanted to react to something that Thomas was saying.
No, I agree with everything Thomas said, of course. No, maybe two points on what I think is important as we take this forward, and it was touched upon earlier in the morning, but not so much in this panel. And it's the how is this helping Europe? And for me, there are two critical dimensions. One is regulation, the other one is technology. So regulation, again, we've got regulation for stablecoins. We don't have regulation for tokenized deposits. That's kind of really strange, right? So let's move ahead on the regulation of not just tokenized deposits, but the whole tokenized ecosystem. And please, let's move ahead at an EU level. I mean, already, and because this is moving fast and member states don't want to fall behind, so we're already seeing initiatives cropping up at national level, this will be a disaster. I mean, this evolution to tokenized market is an opportunity, frankly, to leapfrog all the fragmentation and all the pain and agony that we're going through in the normal SIU discussions to get to scale and harmonization. So if the regulatory process can move in a somewhat faster way than usual, so that we can have EU regulation as this tokenized financial ecosystem develops, it will be a huge boost for Europe, its financial markets, and the savings and investment union. The second point is technology. What infrastructure is this these tokenized financial markets going to function on? We're at risk here, again, of ending up with American rails. Now, I've got nothing against American rails, but we need to be aware, and I think we all are now, that it would be better to also have our own, just in case, right? And so I think, again, that's essential. And perhaps the most nimble, the most agile solution here is to allow the private sector to go ahead at speed, working in consortium fashion, like SWIFT or any other solution. And of course, we need common standards and interoperability. But, you know, even though it's clear the Eurosystem needs to be at the center of this for provision of central bank money in digital form, I don't think you should feel burdened that you need to build the infrastructure and everything needs to. I think perhaps the private sector can be more nimble there. Yeah, that's the. And then last point, which is really important, Alex, you asked the question initially, well, what should be the relationship between the traditional financial system and this new tokenized system that's developing? That's really critical. And while I agree with Mark that in principle the idea of tech neutrality of regulation sounds good, it could also be a recipe for replicating the old system in the new one. And I think we can all agree that's probably not the best way to make the most of these innovations. And I'll give one example here, and Mark, you're not going to like this, but actually neither of you are going to like this, but it's just, you know,
Go for it.
yes, I'm sitting in the wrong place, but.
It's the right place.
The ECB recently announced that it would accept tokenized assets as collateral. That's great, very supportive of development of, you know, tokenized collateral. However, this is subject to that tokenized collateral being registered with a standard CSD. So that's creating a link between old system and new system that, you know, you could think, oh, why do we need this? Okay, so I'll stop here.
Okay, very courageous, but both gentlemen behaving, very good. Before we open up for two questions, I would say, I have a quick crystal ball exercise for all of you, and that is, if you really take a crystal ball, and I don't accept answers where you say, I don't know, you know, just, so, can I go fast forward 5 years or 10 years if you feel more comfortable with that? How do you think the world will look like? And I'll start with Thomas this time. And if you look at the number of seconds left, please not more than 3 or 4 sentences, and I'll, you know, count. And then we open up for 2 questions. Sorry.
Okay, so 3 or 4 sentences. I mean, maybe I frame it also in a way that partly addresses some of the points that were just made. So I would see the world in 5 years or 10 years of perhaps if we are to have tokenization at scale, I think which would be my expectation for the next 5 years. I think we need to have avoided the mistake of multiple investments in infrastructure and instead pool investments at the infrastructure level and allow innovation and competition at the services level. So I think that would be a condition to see a tokenized ecosystem that is flourishing. And I see you, Alex, I'll stop here.
Okay, hand over the crystal ball.
Okay, so first of all, I agree with that. Crystal ball, I will default back on the good work of the ECB, which recently polled market participants to ask them how long it would take for tokenized finance to become the dominant form. And to my great surprise, the average was just above 8 years, with less than 20% of participants saying never, and actually most of those were in the public sector. So if you take out the public sector respondents, it's even more bullish for tokenized finance. So I don't know any better, but that was faster than I would have expected, so that's good.
Yeah, I'd be pretty optimistic, actually. I think 10 years from now, I think tokenization, digitally native, will be pretty much normal, ubiquitous. But I also think not only for end investors, issuers, but also for intermediaries, will be oddly indifferent as to the form that those securities and settlement currencies take. You said at the beginning, Alexandra, that we've kind of been pushed to the front of the stage when we should be backstage, and hopefully we'll be backstage again.
Okay. María.
Well, I think if in 5 years' time, or let's say 10 years' time, success will mean that tokenization is not a separate topic anymore. That it has, it's completely embedded into the ecosystem with interoperability between the different platforms and the new ones. And I'm a bit nuanced, I'd like to add a nuance to what you were saying. I think maybe in 10 years' time, but in the next 5 years, we'll see a lot of infrastructure everywhere. Everyone wants to build its own. I mean, banks want to build their own infrastructures and others and so on. So it's not necessarily a problem if you have a sound, and trusted interoperability layer that connect and make sure that, it's seamless and that people and banks and investors can seamlessly go from one to another. I think the central bank money is really the anchor, and it is even more important in this digital world that central banks really preserve the rule-based financial order and preserve also the stability, the confidence that market participants have in the system today.
Okay, so I'll not summarize what we have discussed. I think that many aspects, but I would like to pick up one point. I think just from the last crystal ball exercise, we very much believe in the fourth revolution that you mentioned, and that this is going to happen actually very soon, right? Because time flies. And now, time for 2 questions that we take. So, who is ready to get Okay, I was hoping for a stable coin intervention.
Yeah, thank you very much. That was too obvious. Alexander Höppner, I'm the CEO of AllUnity, the only German e-money institute issuing MiCA-compliant euro, Swiss franc, and also this week Swedish krona. Yeah, thank you very much. Honestly, I don't really know where to start because we're constantly mixing up, in the sake of arguments and deliberate election, the various ways about what we are talking. So today we have various, let's say, instruments of payment: central bank money, deposit money, commercial bank money, and e-money. And just because we tokenize them does not make the reason go away or make them deliberately more risky. Especially if we use the same technological basis, then the only thing that remains is an issuer risk and not a technological risk. That's the first thing. Second thing is, digital euro is aimed to compete with Visa, MasterCard, PayPal, and Google Pay. Not necessarily with stablecoins, because stablecoins are aimed for cross-border payments. Yes, stablecoins are issued by e-money institutes, which is PayPal. So digital euro competes with the old instrument of payment of e-money institutes, not with the new ones. I think there's also something that we have to take into account. So when we say we have the digital euro to compete with stablecoins, it's apple to pears. The next thing, you want to make stablecoins more secure, no problem, give us direct central bank access for the reserves. Then you would have a hand on the reserve and you know what we're doing there. And I think what Mark said is absolutely true. We are currently so focused on preserving deposits, central bank, retail, and wholesale that we skip and blame everything of stablecoins. But please, MiCA is a fantastic rule book. Literally, the rest of the world is copying it. But since we implemented it, we're complaining how risky it is, how bad stablecoins are. And sorry, it's too cheap to say stablecoins are used for illicit transactions. We used cash for that for the last years and nobody cared about it. So I think we should really, really, really see the chance of that, have good regulation about it, which we, I think, have, and take it as a fourth anchor to payments in the future. And yes, it is faster. It can fill a, let's say, starting role, which then later on is taken up by other means of payment, maybe more secure ones, more centrally guided ones. But there are use cases for that. And especially AI. AI will not wait for 2029. You will not pay your private agent with deposit money or central bank money. AI agents are sitting in China, they're sitting in the US, so it's digital renminbi or US dollar. So we have to think now how we answer to that one, and I think that is totally neglected because we try to preserve a system instead of using the fourth anchor to really be at the forefront of that development.
Thank you for the comment. I think maybe just some comments on the side from Thomas and Isabel, because I think, Isabel, you made in the beginning, in your first intervention, a remark about that you have looked at both stablecoins and tokenized deposits and that you have a preference for your institution for that. However, I think, Alex, you mentioned fairly well that it really depends on the use case that you use them for. So maybe the two of you want to give a quick answer to that one. You too? Yeah. Okay.
Sure. So maybe I can say a couple of words. I mean, I think I was careful in saying that there is space for central bank money and private settlement assets, which include tokenized deposits. And if they are well regulated, well designed, and euro-denominated stable coins, we would, from our perspective, single out a few use cases, which in fact is the use case that you mentioned as well, which is cross-border, where you have benefits from the nature of the instrument. Stablecoins are a better instrument. This has particular value when you don't need to set up particular financial or banking relationships, which may be not so widely available in a specific currency corridor. So there are use cases, and they are the ECB and the Eurosystem acknowledges that in our comprehensive payment strategy that was published earlier this year in March. We are, I think, quite clear about that. There are also limitations, especially when we come to the wholesale space, where the stability, even intraday, of the value of the settlement asset is of relevance because you cannot postpone payments in wholesale financial transactions, and you're exposed to that volatility in the price, even if it's small. So, and maybe I use that to also make a point about the very important clarification that you made. I think we are not on the ECB and Eurosystem side positioning stable coins vis-a-vis the digital euro. If anything, as I said before, the use case for stable coins, we don't see it as primarily a use case for domestic retail transactions, which is what the digital euro is about. If anything, we see it for cross-border, and at that, perhaps more on the wholesale side or the B2B side. So they are not the use cases that are being addressed by the digital euro. So I'm with you on that point. Yeah.
Do you want to add to that, or?
I mean, no. I mean, just to say yes, there are use cases now because the cross-border payment infrastructure is not great, and because there is no settlement asset on chain that exists today. But I guess what I was saying is hopefully in the not too distant future, both of these issues will be fixed, and so the use case will shrink.
Yeah, just a few words. So on cross-border payment is not great today. I just want to correct this.
Very good.
Because the Swiss rails, I mean the interbank rails, it's efficient, I mean it's instant, there's no issue. The issue lies really on the last mile because you have regulation, currency control and so forth. And this we are trying to address in our initiatives. But to come back on your point, as I was saying at the beginning, I mean, you have use cases. So for P2P payments or potentially for retail cross-border payments, why not a stablecoin? I don't know, for whatever use case or whatever platforms, why not? But for wholesale interbank settlement, I mean, all banks are saying, no, we want to have, we are not sending billions with stable coins. So it can be tokenized deposits, but it has to be settled in central bank money. So it depends on the use case, I would say.
Okay, thank you. Any further question? Because we have one left if there is appetite. Don't be shy.
Talking appetite.
Okay, well then, thank you so much for this very lively panel, the clear pictures that we have discussed. It was my pleasure. A big applause to my great panelists, please.
Thank you.
Thank you.
Thank you so much for the great panel, Alexandra. You managed extremely well to have a very complex topic to make it digestible. Speaking of the lunch that comes now in, you must be horribly hungry despite this amazing food for thought. We have now lunch break. It's a bit complicated to get there, but we have posted signs and you have wonderful colleagues that guide you there. You will take the elevators going down through the Großmarkthalle. There on the 3rd floor, you will find a wonderful lunch. And as I said, there will be colleagues and there will be signs, so you will not get lost. And we meet here again at 2 p.m. 2 p.m. back here. Thank you very much. Welcome back to our afternoon session, which starts immediately with another highlight, a keynote from María Abascal. María is Director General of the Spanish Banking Association and Chairwoman of the Executive Committee of the European Banking Federation. She has spent her entire career in the intersection of banking, regulation, European policy, including senior roles as BBVA and the Spanish Treasury. She brings into today's discussion the perspective of Europe's banking industry on digital finance and competitiveness. María, the floor is yours.
Well, after the excellent lunch and gathering, I'm not entirely sure how I'm going to compete for your attention, but I will try to do my best. So good afternoon, everyone, distinguished authorities, guests, ladies and gentlemen. On behalf of the European Banking Federation, I want to deeply thank the ECB for this kind invitation. It's a privilege for me to be here and to participate with sharing the vision of the industry on such a relevant topic. Let me first introduce the outline of my remarks. So first, I would explain the strategic context, why tokenization is important for Europe now. Then I will deal with the distributed ledger technology, both as a new infrastructure and also analyzing different ways of bringing money onto DLT. Then I will refer to differences in retail and wholesale payments. Then I will explain the European response. What do we need in Europe if we want to succeed in the adoption of this technology? And finally, I will briefly comment on competitiveness, our favorite topic. So starting with the first issue, why this is strategically important for Europe now. So as you know, Europe has all the ingredients for a strong financial system. We have solid and resilient banks. We have one of the most advanced regulatory and supervisory frameworks in the world, and we have a very significant pool of savings. Yet, despite all these strengths, European financial markets remain fragmented and, in some cases, not developed enough. This limits the efficient allocation of capital across borders, and, as explained this morning by President Lagarde, it increases costs. And ultimately, it reduces Europe's ability to finance at scale its key priority: green transition, innovation, digitalisation, industrial capabilities, defence, and longer-term investment for growth. So addressing this challenge is therefore not just a market issue, it is a strategic priority for Europe. And this is precisely where the current technological transformation becomes particularly relevant. The infrastructure underpinning finance is now undergoing a deep transformation. Distributed ledger technology and tokenization are opening the way to new ways of issuing, trading, and settling assets. And there is no doubt, Europe must embrace this technology. This is positive for Europe. If properly designed and implemented, these technologies have the potential to address some of the structural inefficiency we face, including fragmentation itself. What is at stake is not simply incremental efficiency gains, but a more structural evolution in how financial markets are organized and how value is transferred and settled across the system, with potential implication for integration and liquidity in Europe. This transformation affects the financial system as a whole, from capital markets and post-trade infrastructure to the way money and assets interact increasingly in digital environments. The key question for Europe is not, therefore, whether tokenization and digital money will develop, they are already doing, but on what terms. And for that, we need to ask ourselves certain questions. Will Europe be able to build an ecosystem that supports more integrated, deeper, and more liquid capital markets? Will this new infrastructure and new form of money be in line with our values, values of stability, trust, and competition? Or will it increasingly depend on standards, infrastructures, and settlement assets developed elsewhere? This is why the debate we are having today is strategic and timing matters. The reality is that many questions remain open and we don't have all the answers. But despite this uncertainty, what is true is that banks are experimenting, are innovating, are exploring different options. We are already doing. And equally important, we need to work together with the public sector to jointly reflect and co-design how money should adapt on this new technological environment and avoid the risk of fragmentation. And as we need to do so with agility, because technology will not wait. So thank you very much to the ECB for organizing this conference, which is so timely and so useful for having this type of discussion. Let me turn to a broader concept of tokenization, not only as a technological innovation, but as a potential structural transformation for financial market. The potential benefits of the technology are clear. First, if designed with interoperability in mind, tokenized infrastructure could help modernize European financial markets, reduce fragmentation, and support more integrated and competitive market over time. Today, markets remain fragmented not only across infrastructures, but also across data, processes, and flows. And this leads to reconciliation processes, different reconciliation processes, operational complexity, delays, and risks. So tokenization can help addressing these inefficiencies more structurally by allowing asset ownership records, settlement instructions, and life cycle events to be managed in a shared or interoperable infrastructure. It can reduce reconciliation and improve operational efficiency. Second, it enables more efficient settlement, including atomic settlement, where delivery of the asset and transfer of the cash take place simultaneously, reducing counterparty credit and settlement risks. Third, it can improve collateral and liquidity management. Today, banks hold significant liquidity and collateral buffers, not only for prudential reasons, but also because assets are often difficult to mobilize when needed. Tokenization can make collateral more mobile, reusable intraday, and accessible in real time, while also enabling the automation of collateral processes. Fourth, tokenization can improve cross-border payments, which remain complex, costly, and dependent on different intermediaries, legacy system, and limited transparency. By combining tokenized deposits and tokenized central bank money on programmable platforms, as explored, for example, by B's project Agora, it becomes possible to support real-time cross-border settlement, multi-currency transactions, programmable payments, and greater transparency. In Europe, part of this potential is already being tested through DLT pilot regime, which provide a controlled environment to assess tokenized infrastructure under operational, regulatory, and market implication. However, we also need to be realistic about where do we stand. It's true that, as I said before, that banks are experimenting are exploring, are innovating different models and use case, but it's true that they are progressing at different speeds. So a first obstacle is fragmentation. Tokenized networks and platforms are developing in parallel, with the risk of replicating existing inefficiency in new technological environment. The second is the absence of a common standards and interoperable frameworks, which makes seamless interaction between systems and participants difficult. The third is coordination. Banks, market infrastructures, technology providers, and public authority all start from different positions and priorities. The fourth is implementation cost and uncertainty. So technology, infrastructure, and governance framework are still evolving, so it is natural for banks to proceed with caution. And finally, there is a central bottleneck, the absence of a generally accepted digital settlement safe asset. This has been raised several times today, that can interact with regulated bank money on DLT. This question of money is not secondary, it is central, because without the right form of money, tokenized market cannot scale. And this brings me to the next point, how to bring money onto DLT. So when we look at digital money in tokenized markets, one message from the European banking sector is clear. Different solutions will coexist to serve different user cases. As the European Banking Federation highlighted back in 2023 in a vision paper, the future points towards a digital financial ecosystem in which assets and different forms of money, public and private, will coexist to enable innovation and support the different user needs. This is why preserving optionality is essential, alongside achieving interoperability. For banks, tokenized deposits are a natural evolution. They are not a new form of money, but existing commercial banks' money in a different technological form. As such, they remain banks' liability, both with legal and economic rights, backed by banks' balance sheets, and covered by the Deposit Guarantee Scheme. These preserve the core role of banks in financing the real economy and supporting the effective transmission of monetary policy. At the same time, tokenized deposits allow banks to unlock the benefits of DLT: programmability, automation, 24/7 availability, and direct interaction with tokenized assets. However, tokenized deposits alone cannot ensure finance settlement across the system. Their limited fungibility across banks and the resulting credit and liquidity risk prevent them from fulfilling that role. This is where central bank money becomes essential, enabling risk-free finance settlement between institutions. For banks, the combination of tokenized deposits and wholesale digital euro on DLT represents a potentially robust and scalable long-term architecture for the European tokenized markets, one that enables innovation on the private side while anchoring settlement in public money, thus preserving the two-tier system that has worked well until now. Once initiatives such as Pontes, followed by Appia, are in place, tokenized deposits should be able to move beyond pilots, closed ecosystems, or intra-group activities and scale across the broader financial system. On the other hand, stablecoins represent another approach to bringing digital money onto DLT. Their main strength lies in their immediate usability and global reach. They can already be issued on existing infrastructures, including public blockchains, making them accessible and relatively easy to deploy across use cases such as international payments, liquidity management, and also they can be used as transactional settlement assets. These largely explain the current momentum, particularly in specific use cases. By contrast, tokenized deposits require a more coordinated ecosystem to scale effectively, including interoperability, common standards, and access to a central bank settlement assets. This difference in coordination efforts help explain the different paces of development, but should not be interpreted as a difference in the long-term relevance. Stablecoins provide solutions that are available today, while tokenized deposits represent a potential structural evolution, given their more natural integration into the regulated banking system. For the banks, stablecoins are therefore not a substitute, but rather a complementary instrument within the financial ecosystem, provided they are issued under a robust regulatory framework such as MiCA or MiCA, and are subject to appropriate safeguards addressing their implication for deposit outflows, liquidity management, and financial stability. Euro-denominated stablecoins issued by banking consortia such as Kibalis can play a role in specific use cases, and in the current phase, help European banks to explore the benefits of DLT and tokenization in a controlled manner, while managing the challenges. This matters because it preserves banks' ability to innovate, experiment, and retain optionality as the markets evolve. Ultimately, the objective is to build an integrated, scalable, and resilient ecosystem where central bank money anchors settlement and private solutions, including tokenized deposits and stablecoin, complement the system where they add value in line with the Eurosystem comprehensive payment strategy. Before turning to the European response, let me simply make the differences in retail and wholesale payments, because the challenges and therefore the responses are fundamentally different. In retail payments, Europe starts from a strong position. Europe has already developed a robust instant account-to-account payment ecosystem, supported by a clearly regulatory framework and the coordination, collaboration, and investment of the banking sector. This is a strategic European asset, efficient, scalable, and cost-effective, and a strong foundation for the next generation of digital payment solutions. European citizens and businesses already have access to efficient, secure, and widely used payment solutions that continue to evolve with users' needs. Global stablecoins, mostly dollar-denominated for the moment, remains largely concentrated in crypto assets markets and niche international use case, rather than in day-to-day retail payments. In this context, we don't see a real risk in the short term, a material risk of widespread digital dollarization in retail payments. The euro remains dominant and trusted currency for European users, supported by a well-functioning payments ecosystem. However, this does not mean that there are no challenges in retail payments in Europe. The key issue is fragmentation. Many consumers and merchants payment solutions still operate mainly at national level, limiting scale and their ability to compete at European and global levels. And Europe remains, to a significant extent, dependent on non-European payment schemes. which raises important questions around resilience and strategic autonomy. Two complementary initiatives are being developed to address these challenges. The first is the Retail Digital Euro project, aimed at ensuring continued access to central bank money in digital form and reinforcing the system resilience. The banking sector has been closely engaged in this project over the past 6 years, contributing to the design choices so that the final solution is workable for users and intermediaries and can coexist with private initiatives. The second, particularly important for the banking industry, is improving interoperability among existing European private payments solutions as part of our broader commitment to strategic autonomy in payments. Through initiatives such as a European Payment Initiative and European Payment Alliance, the banking industry is working towards the objective of interoperability, with the ambition to make tangible progress over the next 12 months. This would allow this solution to scale across borders and enable seamless payments across Europe. Taking together these two projects, public and private, provide a consistent and constructive response to the current challenges in retail payments. Wholesale markets, however, face a different type of challenge. Here, the impact of tokenization is more immediate, and the focus shifts to safe and efficient payments and settlement in digital interconnected environments, while preserving the role of the euro. This requires a different set of rules and more structural response. Recognizing this distinction is essential to ensure that European initiatives remain targeted, proportionate, and effective. If Europe wants to seize this opportunity and move from experimentation to scale, a coherent, coordinated response is required. We see three elements. First, regulation. Second, the infrastructure. And third, the coordinating role of the ECB for that. So starting with regulation, the market in crypto asset regulation, MiCAR, is without any doubt a landmark achievement. It has positioned Europe at the forefront globally by providing legal certainty, a harmonized framework, and strong safeguards for consumer and financial stability. At the same time, the recent Commission decision to review MiCA is both timely and necessary, and we very much welcome. Markets have evolved rapidly since MiCA was conceived, and global competition has intensified, with other jurisdictions actively adapting their frameworks to attract issuers, infrastructures, and liquidity. Thus, the question today is not whether MiCA was the right framework at that time, but whether it remains fully fit for purpose in this new context, not only from prudential and stability perspective, but also from a competitiveness and strategic autonomy dimension. A targeted recalibration of MiCA is now needed to ensure that innovation can develop within Europe, avoiding incentive to activity to move outside, while preserving high standards of supervision, a level playing field, and financial stability. This should include a careful assessment of which additional functionalities may be appropriate for stablecoins, to avoid blurring with the distinction with bank deposits. To scale tokenized deposits from pilots to mainstream use, some targeted clarification might be needed. Legal certainty here is key, and that is why tokenized deposits should be clearly recognized as deposit in level 1 legislation in Europe. In the same spirit, a reflection is also needed for the future DLT pilot regime. The pilot regime has been instrumental in allowing supervisors and market participants to experiment, to learn, to build confidence around this environment. However, it remains too restrictive to support really scale and to enable broader participation in particular due to, to limited participation of key actors, a tight volume threshold, and rigid transition mechanism that constrains successful projects from scaling. If Europe wants to move from pilots to market, the pilot regime needs to evolve, increasing flexibility and providing a clearer pathway towards more permanent framework for tokenized issuance, trading, and settlement. This reform proposed under the MIS package goes in these directions and are positive. Then there is the settlement infrastructure. In that vein, the ECB's initiative, Pontes in the short term and APIA in the longer term, are not only welcome but necessary. They respond directly to what the sector consistently identifies as a bottleneck in tokenized market, the lack of a digital settlement assets in central bank money that can operate natively in DLT environment. Pontes provide a pragmatic response to this immediate need by enabling interoperability between DLT platforms and existing target services. APIA will set out a longer-term vision for a European tokenized wholesale ecosystem, and as such, should be seen as an opportunity to take a step back and reflect more fundamentally on the future design of Europe's wholesale market infrastructure, anchored in central bank money and developed through close and fluent dialogue with the industry. In that sense, for us, APIA is a unique opportunity to build a shared vision from a blank slate, ensuring that resulting framework is both operational viable and aligned with market needs. As bank, we consider that the future ecosystem should not be built around a single infrastructure. Instead, it should rely on several interoperable networks connected to the ECB settlement layer as a common utility and linked through common standards and coordinated frameworks. This would extend the successful target to paradigm into DLT era, combining a resilient and sustainable settlement infrastructure with the flexibility for private sector providers to develop innovative payment solutions that addresses a wide range of customer needs. Competition and innovation should happen at the level of assets and services, while the ECB settlement layer operates as a neutral and non-discriminatory utility. Finally, the ECB and the Euro system more broadly has a key role to play as a catalyst and coordinator on this emerging ecosystem. Its role is not to replace the market, but to anchor it. This means not only providing settlement in central bank money, but also helping to define common rules, standards, fostering interoperability across infrastructure and network, ensuring consistency at the European level. This has also been mentioned today a lot. And we're needed internationally by connecting to and contributing to global initiatives such as Project Agora. This coordination role is essential to avoid fragmentation, liquidity silos, and incompatible solutions. If regulation, market innovation, and central bank initiatives move forward in a consistent and coordinated way, Europe has a real opportunity to move from pilots to scale and to build integrated, competitive, and resilient wholesale financial markets for the digital age. These choices we make across all these dimensions will ultimately be reflected in one key outcome: competitiveness. And for us, competitiveness must become a core objective of the EU. This is not a concern raised by the banking sector. This is a cross-cutting demand from all the sectors. Over the past decade, EU banking regulation has been effective in achieving its primary objective, financial stability, but somehow we have been inefficient in its means because it's broadly recognized that the system is overly complex, that we have gold plating and overlapping requirements. So the industry is not asking for deregulation, but asking for simplification. And just to give you three key priorities, we see a need to ensure stability and predictability of capital requirements. Then we need a holistic view of capital requirements with a mechanism of coordination among different authorities before making decisions on capital. And finally, Europe should reflect on how competitiveness and economic growth can be more systematically considered in regulatory and supervisory frameworks, while keeping financial stability as the primary objective. In parallel, we need a framework that supports the integration of the European market, of the single market, and for that we need to make progress to complete the banking union and to really move forward the saving and investment union. Let me conclude. Europe has a real opportunity by combining tokenized infrastructure, private digital money, public money, and by ensuring close public-private cooperation. Europe can build truly integrated wholesale financial markets. The direction is clear, and we need to do it with agility because technology will not wait. The challenge now is to move decisively from pilots to scale, removing structural bottlenecks, ensuring interoperability, and providing the right settlement backbone in central bank money. At the same time, it's essential to keep optionality and the needed ecosystem. Europe should not converge too early on a single model, as it's hard to predict how will prevail, but rather enable different forms of money and infrastructure to coexist, innovate, and evolve with a coherent framework that ensures stability, a level playing field, and integration. What matters now is execution, coordinated, timely, and at scale, so that Europe can shape these developments in our own terms, preserving the role of the euro and strengthening its competitiveness. Thank you very much for your attention.
Thank you very much, María, for this enlightening speech, and we continue immediately with the next panel, dealing with the business needs of the practitioners, in particular when it comes to cross-border. The panel is chaired by Inge van Dijk, who's member of the governing board of the Nederlandse Bank, and the panelists are María Balan, Senior Vice President and Head of Global Treasury from SAP, Rita Camporeale, Senior Advisor, International Affairs and Payments from the Italian Banking Association, Sam Hinton-Smith, Head of Public and Policy Government Relations from Stripe, and last but not least, Eva Mayboot, Managing Director from Accenture. Inge, the floor is yours.
So, let me see. I think we have an order. So here's María. Yeah. And then Sam is, I think Sam is in the middle. It's okay? Yeah, it's going to work. They'll figure it out. They'll figure it out. That's what we're here for. Okay, so good to be here and talking borderless payments with the value chain of the business payment, so to speak, here on my side. It's a privilege to be able to discuss this. I have a great panel. We had some good sessions already up front. So María, of course, representing SAP, but she's not here to represent the SAP ERP systems. She's here in a role as treasurer. She will have some comments on the ERP probably. But so, and Rita, I think everybody knows Rita already for a long time. So she's been in the central bank and in and out and on the commercial side now. So we sort of swapped side, I think. I went to the central bank and you went out of it again.
Indeed.
Very happy also to have Sam Hinton here as the non-bank participant, and also with a non-EU focus. I think it's good to have on the panel. And finally, of course, Eva with your Enbridge experience and your biz connaissance, but also the corporate advisory role. So we have a lot of information here on the business payment side. So really good to have you with us. We're very much aware that we're after lunch and that we need to make things active and keep you enticed. So we took a liberty to change the plan around a bit. So we're going to do quicker rounds. So that's the key thing. But I'll talk to you about that later. So we're going to talk business-to-business payments. So predominantly it's going to center around European payments, but also international payments. So it's going to be intra-European payments and international payments. Domestic payments we just leave aside for now. So that's the scope of this panel, and that's what we're going to talk about. And I think I don't need to explain anybody here on this panel what business payments has suffered in terms of hosting operational frictions and seeing what's happening. I know that international corporates have always struggled with trying to fit with the various needs of the various countries and ticking all the boxes to make sure that you have a good offering. We'll dive into that later. So the key question is to understand from a business need perspective, where can we improve and how can we take that forward? That's really where the critical element is. And of course, there will be some messages in there for the Market Infrastructure Board or for the central banks or for whoever wants to take the message on board. Anyway, before we do that, we've discussed today already a lot about what will happen in 10 years' time. And when preparing for this panel, I thought, okay, so me talking business payments, you have to excuse me, it's been 10 years since I did business payments. So 10 years ago, I was on the commercial side for a rather large corporate bank doing business payments, and I looked it up in wonderful AI and Copilot and everything that brings you up to date in terms of the World Payments Report and Atos and other consultancy firms, McKinsey, what they brought out there. And just to list you a few things in terms of setting the scene, what it was like in 2015. So this is only 10 years ago. So they list wholesale payment products mainly include credit transfers and direct debits, are complemented with cash management services like pooling and balancing, that I remember. The focus was on e-invoicing. Where did that topic go? That's gone, sort of. But that was a long time on the agenda around that time. And improved reporting, of course, in regards to reconciliation. Fast payments were a novelty, embraced by some, questioned by many, and there were wagers whether instant payments would succeed. We know the answer to that one. The World Payments Report also flagged affordable 3G data services will be around the corner, as well as smartphone penetration. Okay. And we were bouncing back from economic revival. So things were really different. Payments processing was becoming commoditized. Everybody was stepping in, leading to strong price pressure. Banks were looking at legacy systems. Non-bank entrants were set to enter the market. Entering the market, that was 10 years ago. Increasing competition. And corporates always demanding faster, flexible, and more integrated payments to optimize cash payments flow, and much was expected from SEPA, which was at that point just accomplished. So here we are, 11 years later, and it makes me wonder where we will be in 10 years' time. Given at the speed of things are going, no doubt in 5 years' time, the total landscape will be totally different. So we have accomplished a lot in 10 years' time, but we are at a difficult pace. So we want to understand the basis payments need, and that's why we are going to delve into that. We structured the panel with agreement of all of us around 3 items. First, a bit of regulatory talk after an opening statement. Then we dive into the business perspective, understanding what the perspective from the business is. And we will end with the tech part, which is the savvy part, of course. So that should keep us busy for some time. Diving straight into it, and this is a first question for everybody on the team. So, if you look at some of the cross-border payment successes, and you might consider this intra-European or international, in the business-to-business area, what are the milestones that have been achieved of recent in your line of thinking, and what do you think are the most 2 pressing challenges? And we'll try to keep this one short. Can I just start with María on this side?
Yes, first of all, happy to be here, and I just realized I'm perfectly embedded into the environment here, so if I had a bit of yellow with me, I would have been able to apply for a job. So, thank you very much for having me. Yes, I mean, for us really, from a corporate perspective, when you read that, to be fair, I realized a lot of things have changed, but a lot of things have not, right? So if you talk about reconciliation efforts and all of that, I would argue there's still a lot to go ahead of us. So in terms of, say, challenges and regulatory milestones and all of that, for me, the topic of data harmonization requirements and the push towards that has been a key topic. Mm-hmm. So if I talk about ISO 20022, for us has been, I would say, game-changing. Are we there yet? No, but that was definitely a very important topic. Why? I mean, if you think of a corporate, and right, we are basically in so many countries with so many banking partners and payment models and so many subsidiaries, think of the lost in translation moments between payments, right? So lost in mapping, but well, lost in translation. So when one of the banks still, the sending bank is in PAX 8 and the receiving bank is in MT 103, there's still a lot of reconciliation effort on the corporate side. You lose a lot of the structured information, and you have the key challenges. So even when ISO 20022 is an important step in the right direction, and it has a lot more structured data, reliable data, comparable data across jurisdictions, that is a key advantage for us. I think in terms of challenge, there is still a way to go in order to have the whole coverage. So it's maybe coming back also to the discussions that we had. For us as a corporate, I would argue rail is an important topic, but even more, what kind of an environment can carry structured, compliant, end-to-end data within that payment framework?
That's a nice opening question. Evie, might I have your thoughts on this topic?
Sorry.
So in terms of the key things, challenges that you see going forward and what we have achieved, what would be your line of thinking?
ISO 20002 or 20022 is, as mentioned. What I also would mention is that we succeeded pretty much in instant payments. I think 18 months ago, at least in Switzerland, there was still a discussion, will instant payment be used at all? Mm-hmm. It's still less used because it's expensive, but it works at least. And I assume that there are reasons, when there are reasons, this capability will be leveraged. And when I turn a little bit into this new world, I also believe that payments or pilots on DLT move into production, and primarily global banks are having solutions up and running. And what I think was important, and this is happening since a few months, like 12 months, the European banks pretty much want to catch up or want to ensure that they are not missing the investment and still play a role in the payment space going forward. What is missing at the moment, I think we have many little markets, but we need to find the demand needs to find the supply and vice versa. I think this is a little bit the challenge. And when I look into my business, the big gap or friction or a lot of work sits really in the integration into the core banking systems, into the finance system, ERP systems, which is a pretty hard way because not everyone under us is already on this new journey. It's always a long haul. It's a tedious, and the devil is probably in the detail in all of these elements. Okay, Rita, can I have your thoughts on the open question?
I would agree with those who have just exposed their own ideas. I would concur that ISO 20022 is a key milestone. Still, there's some way to go. The next step is also in November with when only structured and hybrid addresses will be accepted. And we do see that the companies have to adapt to that new step forward. But indeed, when discussing business needs, we have always to remember that we don't have one single business. We have many different businesses. One thing is micro, small and medium-sized, large and very large companies. So we can't expect everybody to go on the same pace, and I would even say that their perspectives and expectations would be the same, because that's not correct. And when we discuss borderless payments, we said intra-EU and also across the world. I would say that here we all agree that SEPA is a domestic market, but in this room, if we go out and ask the businesses at large, I'm not too sure that they will concur with us, that Europe is a fully domestic market. Because for a business, the payments is just one part. But we have trade finance, we have different tax regimes, even different civil laws that are so relevant for businesses that indeed there's a lot to do still. So in terms of achievement and compared with 2015, I fully agree that SEPA was a key milestone. We just give it for granted, but it's not. Of course, we still have a way to go for the newborn instant payment to fully leverage on instant payment for the clients and for the businesses. But I would say that one of the key challenges indeed the integration of the whole life cycle, from invoices to reconciliation. So not just the payment, which is just a part of a long process.
Exactly. Sam, I'm seeing that you want to jump in on this.
Absolutely. This
is the key trigger for you, I think.
This is a fantastic conversation already. So Stripe is a financial infrastructure platform that was founded by two Irishmen 16 years ago, so I appreciate the history lesson. That's helpful. Look, the other thing I wanted to say is that we sit at the intersection of C2B and B2B payments. And so I'm really pleased we're having this conversation today, because so often in payments, we talk about the retail side and we talk about the wholesale side as if there's not something very significant in the middle. And to Rita's point, we're talking about some very diverse types of businesses here. So look, I think that one of Europe's superpowers is its ability to create forward-looking and innovation-enabling regulation. I think PSD2 was a fantastic example of that. If you look at some of the fragmentation in other parts of the world, it's still a notable success. We've obviously just had the conclusion of PSD3 at level 1, some important developments for businesses around, for example, clarity on the corporate payments exemption, clarity on what is a permissible payment flow in a marketplace or a multi-sided business transaction. I think the other piece for me is around what we're seeing as a consequence of changes in technology, and I'm sure we'll talk about AI and agentic, and of course, the tokenization of money in multiple forms. So what are the challenges? Just very briefly. So one is that if we look at that technology and the way that it's changing the businesses that we support, traditional financial rails, at least in their original form, weren't designed to enable that kind of innovation. I think the second for me is around friction in settlement chains, particularly cross-border cost and efficiency, and I'm sure we'll come on to talk more about that. And then the other for me is really around connectivity. We have some fantastic real-time payment systems across the world. So of course we think of SEPA, and we think of PromptPay in Thailand, or PayNow in Singapore, or UPI, or Pix. The challenge now is actually how do we knit these systems together to ultimately deliver better infrastructure, of course for consumers, but particularly for businesses.
Okay. That's already an interesting lineup to see whether, I'm interested to see where this could go, but I'll reserve my question for now on this one. We said we would start on the regulatory part. So I think, Rita, you're by far the best example maybe to start with the discussion on what do you think has accomplished the regulatory part so far. We already touched upon it a bit, and then I'll move to María and maybe touch base with Eva for the sound checking on what you said.
Yeah. Well, just some key examples. We already mentioned SEPA, so evidently the SEPA regulation accomplished what the market had already started. Of course, as the market cannot complete the last mile, so a regulation was needed. And IPR, which indeed is a follow-up to the SEPA regulation, is again a good example of positive impact also for businesses. I concur that PSD2 was relevant. For example, in Italy, open banking in the B2B space is one of, unfortunately, the few cases where secure data sharing was really leveraged to improve the market and brought more benefits than expected rather than the retail sector, going to what we now call embedded payments. Somehow the co-legislators, I mean the EU co-legislator, has not always businesses in mind, but rather focuses on consumers, which is not ideal as we discussed, because this creates then more complexity when the regulation is applied also to the business sector. Just an example, going back to the instant payment regulation. We had a verification of payee that was thought as being applied to individual payments, so single payments, whereas we know that businesses hardly have just single individual payments. Then, of course, we had the addition of VOP for bulk payments, but this was super complex, and we are not yet there at European level because there were already solutions in the different countries. And there were even, and there still are, services that don't work at the level of the transaction because businesses want to check their files well before the transaction. So an open question is to the regulator wouldn't that be better to just set the objective without regulating the process? So maybe a little bit of attention to the business sector in that respect would also be important. Of course, at the global level, we miss the certainty that we have within Europe with regulation. And as was mentioned even in the previous session by María, well, international payments are fast until the last mile. And then we have struggling with AML checks, due diligence, GDPR, and different regulatory framework. So still on that side, there's some way to go.
Definitely. Okay, thank you, Rita. Keeping the perspective of the business in mind, whether in size or how exactly, but I already saw especially Anna-Marie nodding when you started talking bulk payments. So I imagine she will have something to say on the regulatory requirements of late and what is good and also what is not so good. We can be frank here, I think.
No, but it's very difficult. I mean, you mentioned a lot of the things. I mean, first of all, coming back to ISO, right? ISO 20022, the one I mentioned before. Critical. But on the other hand, as you say, we have the AML and the sanction pressure, which is increasing on all sides. So we need to be mindful of that. And again, all this harmonized data helps. I think the verification of the payee right for bulk payments possesses a few challenges for corporates. To be fair, I think the intention is very good, and I can always take on a personal level when I pay. I feel much more comfortable when I have my green arrow there. But I think for a corporate, again, in multiple environments, multiple countries, with so many bulk payments, if one payment, right, or one instance it's not correct, it raises some operational complexities again. So not more to add. You touched upon but the three main points in my view. AML and all these new regulations like the verification of payee, which for bulk payments, for instance, put us for a lot of complications.
And so is the AML part then, from a regulatory perspective, moving in the right direction, would you say? Is that something I can ask just off the cuff of my hand?
I mean, it's a dynamic environment, to be fair. And I think, again, since we operate in so many jurisdictions across the world, is very difficult. If you ask my team is increasing on that side. So you can argue, yes, it's more safe and secure, and also new rails and new form of money increase the requirements for AML and for sanctions and all of that. And we all know, right, that the geopolitical environment is becoming increasingly complex. So I think balancing this is important. Is it going the right direction? I would say yes. I think the nuances is what make a difference. If we go country by country, and I don't want to do that, I'm not the expert. I think there's things to improve there, but overall, I feel good, so to speak, the way we're moving in terms of.
I think the understanding of the international corporate in terms of ticking all the boxes and knowing what happens in which country is
Control
really helpful in order to get that
important.
feed also in, because that's a relevant experience that we have. Just to get your two cents on this, Eva, how do you see things from the regulatory perspective in terms of achievements and things that are still on the wish list?
Yeah, so maybe when I complement to that answers, maybe I put on my experiences from a commercial banking perspective and respond to the question how to balance innovation and regulation. I think, and comparing it global banks versus European and Swiss banks, certain global banks, primarily US-driven, work for a couple of years now in that space, and they innovate despite the fact that not everything is clearly regulated. And I feel that they have a very open dialogue to the regulator. Compared to the European and Swiss commercial banks, I feel, at least the ones I'm working with, they are very, very careful not to do something wrong. And there we need to balance really between innovation and regulation. The question is, can we compete if not everything is detailed out yet? And it also takes time to really introduce new capabilities. And this is a big question I have at the moment, where I try my clients to help with.
Okay. I think that maybe ties us also a bit into, if we take up the regulatory part, so the harmonization of data is really very important, balancing between the innovation and regulatory side, trying to leapfrog. Take from Rita the law, please don't tell us what to do, tell us what you want to achieve, and we'll figure out what's the best way to do this. So not getting in the nitty-gritty, but also that's always a balancing act, but we're improving the way I see it. If we move on to the business perspective, I think, Sam, you are maybe the best person to talk to, looking at it also from quite a new, and by the way, I like your striped socks immensely, so just you would want to see that. That's really a very nice touch.
I mean, almost as impressive as
almost as impressive as Rita's, yes. Sorry to get confused. I thought I'd bring you with the tone speed, just to make sure that you catch what Sam is going to be saying on the business perspective. So for you, the main challenges or inefficiencies that you face, what are the things that we need to consider when we talk business payments and the area that you are responsible for? What is needed to address them?
Well, I think one of the interesting factors is that we've seen a lot of innovation in the consumer side, and that I suppose in some ways B2B payments are maybe a decade behind, and perhaps that's because the problems in retail payments are so obvious and they seem so huge. But in some respects, they're even more complex on the B2B side. I think what has changed now is that there is this. I think we've seen the kind of consumerization of B2B payments and B2B solutions. CFOs want something that looks like an app rather than perhaps a traditional B2B payments flow. So look, I mean, in terms of the inefficiencies, I think cost is clearly one. The ECB has identified that 1/3 of corridors still the average cost of transacting is more than 3%. Also efficiency, fewer than 40% of cross-border B2B payments settling intraday. So I think those are absolutely key. I think the other factor here for businesses is, I spoke earlier about the impact that AI and the emergence of agentic payments and indeed tokenization, as we heard from our keynote speaker, are having on the business sector as a whole. And so I think that throws up a whole range of emerging challenges around, for example, increasingly we are seeing that there are B2B software models that don't bill on the traditional monthly cycle, but are billing on a usage-based metric. That's partly a consequence of AI, partly a consequence of token burn, but it's also having the effect of creating new business models. And so I think that's a challenge to those of us who are delivering B2B payments. In terms of the solutions, I think that the tokenization and digitization of money, as we've just heard, is a significant part of that. I think it's one of the reasons why making sure that we collectively land the review of MiCA over the course of the coming months is so important, and ensure that it's fit for purpose and can meet the kinds of policy goals that the Eurosystem and the Commission care about.
Okay, thank you. So the cost of everything, but also what we heard earlier on, payments just part of the chain. So it's an entire chain that runs it for the business payments. It used to be in a certain way, the business payments, but it's changing. That's what you're saying. It's changing. People are embracing different things, and that makes it you have to tie in and get to the new way of working. Things may be evolving also on the business payment side, and it used to be on the retail payment side. It's in your face, but increasingly so on the business payment side as well.
Yeah, if we think about, for example, the need for micropayments in a model where a B2B software provider is billing in real time. We can all think of some stories recently of businesses who have perhaps spent more than they expected to on, for example, AI services. And so I think we're going to see more of that across more sectors. And so micropayments, and on top of that also programmable or conditional payments are going to be increasingly important to really unlock those business models.
I remember 10 years ago, those were also the talk of the town. They were called machine-to-machine payments, and nobody saw anything in it because it was too costly, precisely before that point. But maybe, you're right, the tech has moved on, so maybe it opens these doors that were yet maybe too soon for some. The Internet of Things was already on the table for some time, but it didn't really evolve. So maybe we are at that point in time where these things will materialize. So Rita, maybe back to you. Where do you see that we are going to change? What do you think is going to be, from a business perspective, when it comes to payments? Where is the next challenge coming? What should we address?
Well, I would concur very much what was just said, because I believe that conditional programmable payments are really will really make a change. And in this respect, I mean, linking with the whole morning, DLT-based smart contracts would indeed be the way forward, with the central bank providing the secure settlement asset, and intermediaries offering their customers the smart contracts that they want, and they serve their business. I also agree that microtransactions are absolutely key and will be adapted to the different sectors. But also I would say that improvement in the straight-through processing and integration, as I was mentioning before, throughout the life cycle would be key in reducing the cost. Because, and this goes back to the differences between the various companies, legacy systems might be of a certain, heaviness to change, and we have to consider that. So not necessarily the same standardization would bring efficiency at the same level for all different businesses. So again, more tailored, and indeed, tokenization and the new technology can help us tailor to better cater for the needs of the different companies. So I would definitely say that this is the way forward.
Okay, and maybe Eva, then to you, if we see this as the way forward, how would you see the role of banks and fintechs and newcomers and corporates, the ones with legacy, maybe I should say the ones without legacy? How do you see them moving into this space of standardization and innovation? And you were already talking earlier on about the balance a bit. So will there be winners? Will there be losers? Who will come out on top? Is there anything to say in this regard?
It's a very interesting question, yeah, what is the role of a bank, a commercial bank, going forward? And this is what commercial banks ask themselves at the moment, pretty much. And one theme is that they remain the trust layer, so they will ensure compliance. And also will provide the convenience to the client. So the user interface and the wallets and the front end really most probably will remain with clients, with commercial banks. And considering the speed of the fintechs of the world, I believe that they will be a puzzle piece into the ecosystem, and you already see it that big players are very open nowadays to collaborate with those new players. Okay, so we will see a new ecosystem coming out.
If I may,
yeah, definitely.
Coming from a banking association, yeah, we often think about the role of banks. So especially in the cross-border space, I would say that the bank or an intermediary helps reducing the complexity, and that's what the customers want. Because going again globally with all the compliance issues and different settings. You need an intermediary that reduces the complexity for you. And that's, I think, a role that will remain.
Okay. See, a new role for banks. So banks will be here. That's clear. That's a clear statement, Rita. And I can imagine you want to jump into on that. There's another question I wanted to ask María, because María is a bit the customer within her own corporate. So she's the treasurer. But also, of course, you know, SAP provides the ERP system. So in terms of the value chain and how that works frictionless, where do you see that, what will be elementary to drive efficiency? The one thing that you want is probably the message you also give internally.
Yeah, I mean, look, if I come back exactly to your point, complexity, right? So of course we expect every partner and every member of the ecosystem to reduce complexity for their role. On the other hand, we also want our ERP system to help with the management of that complexity, right? So what we want is to become, well, rail agnostic, if I may, and also bank neutral. So that to be, you know, the systems in the sense that, you know, let's say, so a payment factory which is integrated, which is also the case today, right, which is integrated in the ERP system, its strength, its operational asymmetry. So upwards, sort of the business processes, it's bank agnostic, it's bank neutral. Downwards, it speaks it should speak every bank dialect, every format, every cutoff time, and all of that, which is extremely helpful in managing this complexity. In the end, of course, is encapsulated in that and not having. And the second point, sorry, in terms of rails, right? We talk about a lot of new rails coming up with pros and cons and niche use cases, a lot of variety in terms of SMEs, different sizes of companies, different legacy systems and all of that. Ideally, from an ERP perspective, we reduce the barrier of entry for having these new rails embedded in the ERP system. That's why we need to move away from an architecture or from a individually integrating different payment methods to having an architecture where the rail becomes actually interchangeable. So each company can then be flexible. For me, flexibility is key, and it's not just for payments, but ideally in a world where complexity is so high, the more flexibility you have in terms of liquidity, in terms of payments and so on is key. So encapsulating this complexity and becoming bank agnostic and also abstracting the rails is the way to go, in my view.
Yeah. I think the rail agnostic part is really an interesting concept also in terms of, so essentially you're saying let's avoid lock-ins. Let's make sure that the basic rails in terms of the standardization that ties probably into the ISO 20022, now the standard for the world, I think, and there's lots going also from the BIS in terms of getting the last frictions out, which is really, the devil is in the details, so there's some really good German banks and other parties also working on that PI task force to deliver that last detailed bit. That's not easy because, as you said, AML, those specifics still exist per country, but also FATF, you see, moving in the right direction. Everybody's understanding that this is really very important, but it's not easy to deliver rail agnosticness and to avoid the lock-in. And still there are some new parties sometimes out there I see that are trying to get a lock-in again. And whereas in general you would want to move out of that.
Yes.
What does it take from your perspective to, what do you think is mandatory for, because SEPA's just SEPA, it's just Europe. So Europe is an important continent, but not the only one, certainly not in soccer these days.
Yeah, that's a very good question, but that's exactly the same. The problem is it's also not static, right? So even if you have one, let's say, and you're becoming agnostic, even if you would manage to become agnostic to the rails today, the way they are today, that's not a static system. So everything is changing. Yeah. Is true rail agnostic possible? I don't know as of today, as you say, but I think it's a target to be in, at least from a corporate perspective, in my view, and move towards that. But it's a, chicken and egg kind of problem in the end. But of course, the more we lower the barrier and the more a lot of technical capabilities like AI and all of that help us and threaten us as well, right? It's a double-sided coin as well. Definitely. I think having this, vision, I think helps a lot.
I think it's also a very different perspective from, if you talk from SMEs to mid-corporates, to domestic corporates, to international corporates like yourselves. The demand and the need for what they need is so very different. Some are, please give me something simple, I want to make sure that this lasts for 10 years and don't change too much, whereas others are in a totally different game. So there's a totally different perspective. I think you already highlighted to that. Anyway, just wanted to make sure that we are now trying to move on, and I think we have some time left to do this well, to the technology part, and also consider what innovative solutions are now out there. Sam, if I can just pick your brain again in terms of what PSPs and fintechs are developing to improve these end-to-end processes, where from invoicing to reconciliation, or maybe else. Can you share with us your thoughts on this?
Yeah, of course, delighted to. Well, look, we should certainly talk about tokenization, and I should explain that over the course of the past 18 months to 2 years, Stripe has made a number of investments in the tokenization and stablecoin space. So we acquired a stablecoin orchestration company last year called Bridge, and have also made a number of other investments. Now, we've done that not because we're evangelical about the technology, but because we believe, and in fact we see strong evidence that there are real-world problems that are faced by businesses that can be solved in part by that technology. So the use cases that we are most certainly seeing, one is cross-border payroll, paying workers in other jurisdictions. Secondly, cross-border payments, particularly in developing economies where maybe you have a big global corporate that wants to be able to access markets across, say, Africa, but wants to be able to do that in a way that is both efficient and also manages some of the currency risk and other volatility that could be associated with existing rails. And then I think the other really important one that we see is around corporate treasury management, where we do have corporate treasurers coming to us and asking us for assistance in solving some of the problems that the challenges that they face. So I think, look, I think stablecoins are going to be part of the picture. My personal view is that tokenized deposits and indeed central bank digital currencies, both retail and wholesale, will be involved in solving the challenges of the future for business users of all types. But I think we're on the money if we're looking at tokenization broadly and the real world problems that it can solve, not just today, but when we think about the business models of the future.
Okay, so interesting development. I'll ask you later which one is going to come out on top of you, so you can think on that one. Okay. But maybe moving on to Eva. So Eva, if you look at the most important tech developments that you see, what are the top 3 that you would highlight in terms of tech developments in business payments?
Next to what has been mentioned already, I think, and it was slightly touched as well, is on the agentic space in the payment space. where I believe that agents will order and will trigger payments, maybe not by having access to our own accounts, but maybe using a medium that is defined like a stablecoin. What I also think will succeed, will be looked into more, is around conditional payment, programmable money. So I think we are working, the corporate world is working with finance processes that at best work with digital invoices. But the question really is, do we need those digital invoices to reconcile later against the payment, or could we use certain data points directly? There are certain front runners in the corporate world, but the financial service industry needs to have much deeper discussions, not only with the treasuries of the world, but also with business development, to develop services and products at the front.
Okay, so agentic payments using the middle, so the stablecoin layer becomes sort of a like a layer, an access to the backend system, where you can sort of condition. Is that the way I would frame it, or how?
Yes.
Okay, that's interesting. Rita, your two cents on the three tech developments in terms of what you think is most interesting looking forward.
Well, I think my colleague panelists have said it already. Definitely agentic AI and programmable and conditional payments. And here again, looking at the objective, then you can make it in practice in different ways, from very simple ways like having a request to pay plus instant payments that you can create in a modular way, to, of course, DLT-based smart contract, and Sam already mentioned some use cases. And yeah, I would say that that's the core of it. Then we are already there in many cases. But again, having, let's say, the whole business sector onto it will require time. Mm-hmm. And here again, I think that Europe can lead, but needs to go forward quickly, as many times was mentioned today.
Okay. Is there any continent that we can learn from? Because it takes time, you said. Are the continents that you're looking for to think, okay, that's the way we need to go, or is this maybe something difficult to answer?
Yeah, maybe.
Okay, it takes time. So, Anna-Maria, from your perspective, how do you see, what's most important from your perspective as treasurer?
Yeah,
most interesting, maybe?
Look, I think all of them were mentioned, and I think I'm a big fan of programmability, to be honest, right? So I think, smart contracts we've mentioned a number of times, and I think that has a lot of potential, not just to make payment faster, but smarter, but coming back to the integration into enterprise processes, right? So sustainable scale in the end for all of these cases, it's also a matter of integrating into enterprise processes and end to end. So I think, again, agentic, as SAP, like we all in on AI and the autonomous enterprise, coming back to your point, yes, we do believe that agentic AI will be in payments and all of that. There are risks, of course, associated with that, but that's a different panel discussion, much more.
Yeah, we could talk about the risks and fraud.
much more broader. I think in the end, one point I would like to make, so again, the integration end to end is the critical key for us, regardless of each of these developments. But also we need to be careful, in my view, that with each form of money or which new form of technical development, that we believe that they will not also fall into the, let's say, complexities and issues that we already have. So with scalability and with once they achieve scale, I could argue it remains to be seen. Every new form could still come into new fees, right? People could still begin charge stuff which is not being charged today. You will still have the regulation, the governance. That could be a lot more complexity than we see today for these different use cases. All of that comes with IT, with organizational integration, with user interfaces and all of that. So we need to make sure that the complexity for each of those is not higher than the value that they add. So I would say we need to look at all of them and see for which cases and which stage of a, for an enterprise. again, I'm a big fan of most of them. I would say not all of them, but we have to continuously monitor.
So it's all about possibilities and business cases. And
that's my view. I'm a risk manager, right? I'm a risk manager. It's all about possibilities.
I thought you were an economist by heart, also somewhere along the line, if I read it.
Yes, but flexibility and optionality is key for me.
Optionality, nice word. I like that. So maybe closing off to a little bit in terms of looking at the progress so far made in Europe. I wanted to touch base first and to see whether there are questions in the audience before we move to our last giveaway. Just making sure that we. Is there anybody who wants to ask anything from a business perspective? So far, things are silent, so that means that I get to give you your magic wand. I left mine at home. I'm sorry for that. I've got a great magic wand. You can put a card in there, a contactless card, and you can tap to pay. I love it. I tried it out at the Dutch Central Bank. It's wonderful. So, but if you had your magic wand, Eva, and you could implement one transformative change to improve the cross-border, the borderless payments, what would it be?
I think I would keep the two-tier system as an assumption, and I think what is very important now to get the settlement layer for the deposit tokens.
The settlement layer for the tokens. Okay, well, there's work going on that one. Sam, may I have your votes, please?
So I would say to my fairy godmother, Inga, that a European business paying a supplier in Malaysia or a creator in Nigeria can enjoy the same speed, cost and transparency as if they were making a SEPA payment here to a company in Frankfurt. Whether that happens over RTPs or stablecoins or tokenized deposits, what matters is what works.
Okay, I like it. I like it very much, but I'll tell you later why. Rita.
The magic wand, full dialogue between the various actors of a payment chain with the regulators and a true cooperation between private and public sector in a common vision towards efficiency and competitiveness, as María said before.
Thank you very much, Rita. Anna Maria.
Well, first of all, if I may, I hope I have 3 wishes, because payments, if I would have a magic wand, payments would not be my first absolute wish in life.
You get
please don't mind, but I would have some other preferences first. But if I had more, let's say, mod options, I would say maybe less glamorous than a new technology. But I fully agree with you. I mean, and I think in the end, that's the end key. I would start smaller and say even in the SEPA, we still have some improvement potential, right? And especially in the B2G space, right? So I would say full functional coverage of SEPA where it is available, combined with a ISO 20022, which speaks the same dialect, ideally. That would be, for me, very, very effective in a corporate environment. And that would be enough in a first step. Moving toward your, let's say, vision, but in a smaller step in SEPA.
I like all of these ideas. If you put them together and we put them on a tile, we get a great magic wand. I think some of the things were gripped from my heart. I'm not here to say anything, but I think it's time, high time, that we come together and build strong Europe. We've been battling for a number of time, all of us for good reasons and with passion. I know that for a fact. Everybody here from private sector or public sector is always passionate about whatever they do. So it's about understanding each other and coming together. So that is really from the heart. True speed across the globe, I like that a lot. I think the two-tier model is also very essential. And probably we should start small, because if we start big, I'm always worried that we end up in endless talks. And that doesn't really, we have to start working very hard. So with that, I would like to thank you, my panelists, and give it back to Jürgen.
Thank you very much, Inge and panelists. Inge, you made it very energetic and lively and even entertaining. Great. I have no magic wand. I have a clock to watch, and I give you now a break of another 30 minutes for coffee, and see you back 5 to 4, please. Welcome back to our final panel of today's conference, dealing with retail payments in Europe. Definitely worth collecting the remaining energy of the conference to listen carefully in. The session is chaired by Carola Westermeier, Professor of Economic Sociology of Philipps University Marburg. The panelists are Agustin Reina, Director General of BOIC, the Consumer Association, Davide Rossi, Director General of AIRES, the Italian Association of Specialized Household Applicant Retailers, and Managing Director of EU CERC. I don't spell out the acronym now. Then we have Joachim Schmalzel, Chairman of European Payment Initiative EPI, and Executive Member of the Board of German Savings Banks Association. And last but definitely not least, our Director for the Digital Euro, Evelyn Whitlock. Carola, the floor is yours.
Yeah, thank you very much, Jürgen, for the kind introduction, and obviously thank you to the whole organizing team for bringing this together. It's my pleasure to chair this last panel, so obviously we do have a sort of hard job towards the very end of the conference, but nevertheless I think this perspective and the perspectives here that are presented deserve broader attention. So before we start, allow me to paint very briefly the broader picture that is the background of this panel. So what we have is citizens' payments habits that are changing rapidly. We have raising expectations for seamless, secure, and widely accepted payment solutions. And at the same time, we have fragmentation across instrument and payment solutions here in Europe, across providers and national borders, all of which risks weakening resilience, competition, and we've talked about this a lot, a European autonomy. So the two developments that the President Lagarde mentioned this morning come together. So, and they intersect. We have intensified use of new technologies. We have new technologies rising. We have been speaking, or hearing about AI and obviously new infrastructures. But we also have increasing importance of geopolitics and payments. So everybody's aware that payments is not something, as we've heard in the beginning, that's just going on in the background, but it's been coming and has obviously received wide political attention. So this is also present today and here in our thoughts and our deliberations. We've heard a lot of what is currently going on and what's been developed and what's developing in the previous panels. But we've so far heard mostly from, obviously, authorities, central bankers, and industry representatives. But now we will also widen the perspectives here. Because not only in this room, but also more broadly, in societies and in the political sphere, the impression that things are moving fast and things could be disrupted and our established order is in danger, that is something that has been shared across sectors and across different spheres of society. So as I said, the panel extends the scope and the perspectives previously presented, and we will also address the needs of consumers and merchants, and these are represented with Agustin and Davide. So for the just to be clear, for the consumers, small consumers, and for the merchants, Davide. And yeah, we've heard before in the previous panel, I found this quite interesting, that once we bring in the needs of consumers into the regulation, then it becomes complicated. So that's interesting in itself. But we will also talk about the priorities for the digital euro. And here, Evelyn is definitely the best representative here to hear about that. And private sector action that could strengthen innovation, integration, and resilience for European retail payments. So we will continue the order as we've had in the previous panels, and we will first have an opening question that I'll address and direct at all panelists. And then afterwards, I will follow up with specific questions for each of you. So as said, consumer habits are rapidly evolving, we know that. Simultaneously, we are debating the need for, let's call it resilient, whatever that may be, and we've heard about it, some options and some desires and some needs in the first keynote lecture. So we are debating a need for a resilient payment ecosystem, a term that acknowledges the uncertainties and potential threats that we face. And as we've also seen recently, the potentialities of these threats in the digital spheres are becoming, fiercer and more drastic in a way, and something that is not just, let's say, a simulation or a potential scenario anymore. So what do you, each of you, consider to be the biggest challenges in meeting the retail payment needs of consumers and merchants on the one hand, while also acknowledging that in Europe today, we are finding ourselves in a very much changing international landscape. So bringing these two together, what are the main challenges? Now we'll start addressing you, Joachim, first, and hearing about your ideas.
Thanks. I think we have two main challenges. The challenge number one is that digital sovereignty in payments or identity is not coming by regulation or by order, but by usage of the people. And usage of the people is then if it offers added value, and if it's easy to use and it's convenient and it helps them. And that's, I think, one of the main things. We, as the Saving Bank Group, we have roughly 40 million customers, half of the population in Germany, and it's not that easy to convince them to adopt to a new payment method or to something new. We have some failures in the past. And it's always that if they say that, oh, it's a trusted version, it's very good, it helps you, they don't use it. They use the easier one, the more convenient one, and it's from the US, they use it from the US. There's no ethos in usage of these things. It's my perception. So we think that we need to combine the trust issue, the identity issue, the usage with actual needs of the consumers. And this is where we try to help them, to make it easier in every need. This is the one hand side. The other challenge is that we do everything in parallel now. We do digital identity with the digital wallets. We have a lot to do with MasterCard and Visa because they put out one mandate after the others to enrich their payment system. We have something to do with the Giro card to offer it on public infrastructure support and so on. We have the Viro, the big one for us, and we have the digital euro. So this is the second challenge we have. The first one is you have to convince the consumers, and that's not easy. And the second one is you have this extreme conflict on resources. It's not money, it's resources. That's the main challenges.
Okay, thank you. Continuing with Agustin, what are the main challenges in your view?
Yes, thank you very much also for having us in this conversation. Perhaps a framing point, the consumer's expectations and needs versus market structures. Because here what we need to be mindful of is that it's not only the consumer's expectations that have evolved, but also the market and the innovation that the market brought to consumers. Just to give a very blunt example, no consumer that I know asks for contactless payment. And still they are using it because it is convenient. So when you offer something to a consumer that is convenient, easy to use, they will pick it up. And that will make this changing consumer behaving much faster and scale. But of course, when innovation comes to the market, it also comes with a responsibility. So then when we look at this sector and what are those consumers' expectations and needs or concerns, a year ago, we asked our entire memberships, all the national consumer organizations, that they do market surveys and trying to understand what basically keeps people awake, what were the main concerns. And the main concern that came on top was payment fraud. Mm-hmm. It was really interesting because that was very close to even the cost of living, because people had been confronted to this, had been fall victim, and as we know, in most of the cases with authorized payments, is the consumer actually that bear the costs and the losses. but also the simple fact that we cannot expect people to be consumers 24/7. If you're using a payment system, you hope to be trustful, to be easy to use, to be convenient, so on and so forth. And also when we look at specifically these market structures, of course, consumers might have a lot of cards, consumers have a lot of apps, but the question is there sufficient choice in the underlying infrastructure? And is that choice inclusive enough? Because that comes also with the question of the decline of cash accessibility. Cash is still today the most inclusive means of payment that exists. So the question is, as we move quite fast towards the digitalization of payments, how we make sure that we have an inclusive approach here? And I must say, I'm very supportive of models like Wero. I think that we should have as many Weros as we want, all interconnected.
Only one.
Fantastic, only one, all interconnected, fine. But that's not enough. And there is where we look at the Digital Euro project, which is a project which is designed with the public interest in mind. And it will be an additional means of payment for the consumers, but with a different mindset in the way that is being developed. Thank you.
David. So 2 main points of concern. The first one is very general, and the second one is going directly to the content of this conference. First of all, thank you for this opportunity to speak on behalf of European merchants. My association is the association gathering the companies which are selling electronic products and major domestic appliances, but we are part of Eurocommerce, which is representing all the retailers across Europe, and I would like to thank Atsifas, who helped me to prepare this conversation today. So in this field, the major problem for merchants in Europe, and I use the word merchants instead of retailers, because retail in the banking world has a different meaning, so maybe someone could misunderstand the 2 roles. We speak about simply the companies which are buying a product and selling to consumers. Okay, we are the merchants, physical products. And the main problem is called 6 billion parcels entering in Europe every year. Every year, every day, 16 million parcels, small parcels entering this continent. Since July 1, at least they will pay €3, which is a sort of minimum fee to get in. But all traders, all merchants in Europe have to consider that there is a place in China where a parcel is starting from and arriving here. So this is happening in incredible growth. It was just 2 billion 3 years ago. So multiplier is incredible. And we are in front of this issue for all retailers. Plus, there are important China group which are looking at European retailers, in particular German retailer, very important in our sector in consumer electronic. This is also under scrutiny by the Commission. We shall see what will be the decision of the Commission concerning this important acquisition. So, but once the level playing field issue has been somehow solved in a way or in another, there will be the problem of competition. Margins are getting every day lower. In consumer electronic, the margin forecast is 2% of the turnover. So we make a lot of business, a lot of money around, and what remains in the company is 2%. After 1 full year of hard work, of delivery, of installation, of technical problem, of legal problems for the lawyers like me, whatever it is 2% when is a good year. And so this means that any part of the management of a company must go perfectly. And payment is part of this. In the past, probably the most important guy in a company was the commercial guy. He's able to sell, the selling department. They were acting like kings in a company. So I remember many years ago, I was a lawyer in a company, pay television at the time. Arrived the guy and say, I bring the money, you lose the money. So this was the attitude of the commercial directors and the sales force of a company. Now it's no more like this, because you can be as good as you are, but if the company is not competitive in terms of general costs, in general of management, the company will not go well. So more and more companies need to have a perfect execution in any part. Compliance, environment, image, attracting the best skills. Any part of a company must work perfectly. And payment is definitely a very significant part of all of this.
But, this was already a diverse set of challenges that we heard. Evelyn, at yours.
Yes, indeed, it shows that it's good to have people with different perspectives on the same thing and then all seeing different challenges, but potentially we find a common way forward. No, so if you look from a central banking perspective, what we see is we have always been providing cash, as was said, and there we see that cash is very good, and it's one of the solutions that people like to use, but we have become more digital overall. So either in a physical world we prefer to pay more digitally, or there is only a way to pay digitally because it's an e-commerce transaction or stuff like that. So this is a challenge for the current product that we have and the means of payment we provide to the end users. And then if we look to the digital means of payments that are available in Europe, we see that we are very, very reliant on non-European solutions. So, and that is something we think in the current day and age is something that is not good for our sovereignty, for our resilience, is something that we need to get rid of. And therefore, one of the solutions, of course, from a central bank would be to think about a digital euro, which is a topic that we have been thinking of. But as we have also said in the comprehensive payment strategy, we do believe that the answer is not the digital euro only. It's really a digital euro together with more private European solutions. And we believe that with the digital euro we could do that together. Of course, then we can address some of the challenges, I think, together, both on the consumer side as well as on the merchant side. And then the concerns that were raised by Joachim are more on, okay, if we agree that this is the thing, how do we get it done? So how do we make sure that people start paying more European, and how do we plan the project in a way that we can achieve those goals? But these are more fundamental questions we try to address, but they are very relevant.
Mm-hmm. Yes, okay, so that was already a broad landscape of challenges, and absolutely, and they often come together within the Digital Euro project. But let's first of all dive deeper into the topics of fragmentation, resilience, and strategic autonomy. Again, Joachim, I'm asking you, how does that, fragmentation across payment solutions and national borders impact the Euro retail system? I mean, obviously, you're an expert on this, and how can the European Payment Initiative also help overcome these fragmentations?
I think there is a clear need for a European payment solution, because we are the only region who has nothing combined. We have different solutions, but nothing combined. That was the reason why we started the initiative of EPI, and it was not easy, but we are now happy to have 55 million users on Euro. We are increasing, we're getting new countries on Euro. We are combining this with an interoperability hub with the other digital European solutions like Bizum, Vips, Bancomat, or MBPay. And it's underway. We will do this in the POC was already done on the 16th of April. It was my birthday, and they did it for me, I think.
Yeah, just a present.
And we will roll out at the end of the year with P2P and go over with the other use cases. So there was a pressure to increase the speed of pan-European reach for Euro, and this, I think the good solution is that we, on the one hand side, integrate the current payment solutions from Germany, France, Belgium, Netherlands into one. We are eager to integrate more if they like, and if they don't like to integrate, we cooperate with them. So there's a huge reach on this, and this is a new strategy. The cooperation strategy was not right in the beginning. In the beginning, we were very strict and said only integration, because then you have the best out of it in investments, because then you invest only once and not different times. But it's pretty clear that the consumer in Spain likes Bizum. And we cannot transfer the Bizum user from Spain to Euro. So it's better that we combine the two solutions, making interoperability. And there is an open
an open hub. We already have speaks with non-euro countries in Europe to combine their solutions. And we are also open, and we heard them from the countries outside of Europe that they like this idea of interoperability, which makes it easier without using the rails from the ICSs to pay in all use cases in payment here. And the basis is instant payment. SEPA instant payment is the basis infrastructure. It makes it easier to connect for all this, for the payment solutions, and makes an easier start. It's not that it's a perfect interaction. It's not that you always have the same use cases which is by Vero. I simply think that Vero is the better solution, but that's a little bit biased on that. But you can connect, you can pay. So I can offer to my German saving bank customers, if you have Vero, then you can pay with, I think it was 160 million people in Europe are using at the beginning. We are increasing with other countries. And I think that's the sovereignty we need now, because we need now sovereignty, not in 4 years, not in 5 years. We need it, and because it's a long way to adopt the people to the solutions. So if you adopt it to the solutions when you have a way to go, it's better to start earlier. Mm-hmm. That's the vision we have on that.
Mm-hmm. So, turning to the perspective of the ECB, it's often asked, how do the two initiatives come together? Do they come together, and how do they, complement maybe each other? So it's a good question now to you, Evelyn. How does the digital euro address the basically same problem, but maybe also where are the differences?
Well, first of all, digital euro in itself is an additional choice. So there will be cash, there will be private solutions, and as we said, we very much encourage that would be much more European private solutions. And then there's the digital euro. So in itself, it adds resilience because it's an additional choice that can be made. On top of that, in the design of the digital euro, we also have the offline digital euro, which protects against not having internet connectivity or electricity. Of course, not forever. At some point, you need to reload your devices. But it is an additional measure which makes us more resilient going forward. So that is one element of the digital euro in itself. But then, as we said, and I alluded to that before, we believe that with the standards and the infrastructure, if we do it in a clever way, we can bring some value to the private solutions, and this is mainly in setting industry standards, and mainly also to have a common layer on the acceptance side, because as Joachim said, on the infrastructure side, it is built on instant payments, but there is not which is a European standard, but actually on the front-end side, we don't have these European standards. And with the digital euro, specifically in the POS space, we think this is something that could bring value and is an open standard and can be reused by European schemes, which will facilitate also interoperability or making it easy for a merchant to accept multiple schemes. So that not that if you want next to digital euro also accept Vero and Bizum and somebody else, that you need to implement 4 different standards, but there's one technical standard that allows you to accept all. So that is one element where we think we can add value. On the other side, we think that the private solutions can add value to the digital euro by integrating the digital euro in their solutions. Like we have Vero here on stage, but also other solutions have already a front end, which people use, that they are used to. So if we can integrate the digital euro, or if the banks, payment service providers would choose to integrate it in there, it would facilitate also the life of the consumers. They don't have to adopt another front end, for example. So there we see that together we are stronger.
Mm-hmm. Okay, so we've heard from the private proposition and the public proposition that the digital euro present. So Agustin, again, turning to the perspective of consumers, what are your key expectations for achieving resilient and truly European payment solutions that prioritize the consumer's needs for, I think, as you said, ease and convenience? Yeah? These are definitely most important needs of the or preferences of the consumers. And then also, how do you view the role of the digital euro and also market-led initiatives in fulfilling these needs?
Super. Here, what I think we need to look at is, of course, there is the question of choice. What are the actual choices that consumers have to pay? If you look at the current ecosystem, 90% of electronic payments are being done through Visa, MasterCard. There are only 6 domestic schemes remaining in Europe, so we have a problem of choice here. And that is where we see the role of the digital euro coming into play as well. There is the elements, we say, of resilience. And then the third point is the added value. So basically, why people will choose for it. And here, for us, was extremely important to check with consumers. So what consumers think about this? Do they know, first of all, about this project ongoing? And actually, there was some level of acknowledgement of it. But concretely, if they will be able to design the digital euro, what are the key features that it should have? And I can bring you 4 characteristics. Security became extremely important, also in relation to the protection against fraud. And then easy to use. People also want to have access to a physical card in order to be able to make payments. Privacy, that came out also quite high. So here we're talking about developing something that goes above even the regulatory requirements that we have for the private sector. The universally acceptance as well. So no matter where you go, you don't want to be mingling around with different cards. I think you want that merchants accept it. And here, of course, the question of the possibility for an offline use is a very important added value that it has as well, because that also gives you peace of mind that if there is no internet or it's a problem, you are still able to make a payment. So we need really to look at what are those drivers that will make the acceptance of the digital euro higher among consumers. And then, of course, there will be a question of political choices as well. So the politician will have to decide how attractive they would like to make the digital euro. I will have to say, you have to make it really attractive, because if you really want to make something that consumers can meaningfully opt for, you need to take that step. And I must say that the ECB is taking the responsibility to put this on the table. But of course, there is a political decision that needs to be made by the co-legislator in this regard. And I hope that the banking sector present in this room will continue supporting those endeavors, because at the end of the day, it is for the resilience of our payment system in Europe.
Davide, turning again to the merchants, how do you see the potential of the digital euro and private solutions in fostering what you call perfect payments, higher competition, maybe also lower fees, and essentially improve?
Of course, once again, merchants take the liberty to be broad brush sometimes in their considerations, because the important thing is that they can be free when they make things, but they must have a duty. They must go down to earth and make their maths very well. So the first question mark that was raised to me is how much this will cost, how much will be the effort in order to enable our points of sale with this. And if in the future, in the short or medium term, this will imply reduction in our fees, is a good thing. But the money we shall spend upfront. So this is the real first attitude that has been raised to me. So it's a good idea. We are ready to support the resilience of the payment system in Europe. It's important for sovereignty. It was very important in the keynote speech we were listening this morning to know that not only the announcements that this will be done will create effects, positive effects in other possible or supposed to be competitors, in other schemes, but the real essential point is, okay, this will be dropped from the sky and imposed to merchants that must offer this possibility, because this will be legal currency. So they will have to accept anyway. And what will be the payback for that? So this is the real point. I'm not here making a commercial, of course, issue, but the first hand raised that I received when I was asking to the table, what do you think about this, was this point. So it's very important to work on this. I think that associations and European Confederation, they have also the role to explain to our operators that there is not just the final accounts of the company, but there is a major interest, which is to keep the world like it is. A little bit better, but like it is somehow, not to let the world in the hand of agentic AI or not European systems. That's okay. This is let's say, a combination of things that I think, I cannot speak, of course, on behalf of the European merchants, all of them, but in my view, I think there is the possibility to convince all to move properly, but it must be a process that has to be done together. So to something which will look like imposed will find a little bit of boundaries, a little bit of opposition. So it's something that we should work on it.
Mm-hmm. Okay. Turning back to Evelyn and Joachim and asking how, first you, Evelyn, how then the digital euro and will help strengthen, I mean, also not only European competitiveness and the resilience of retail payments, but maybe also address some of the very much dire needs of consumers, such as security, safety, and so on. Maybe also on the sideline and to address this, and also from the merchants. I mean, this is a lot to ask, or maybe you can address some of it.
Yeah. So on some of the coexistence of and how we can benefit from European schemes and vice versa, I've said something. So let me also focus a bit on the points that were raised on the table. So from the consumer wish list, or the things that they find important, the security is, of course, of utmost importance, and that is something no payment scheme should compete against one another. I think, and also a fight against fraud is about sharing information and making each other more smart. So if we look to the digital euro, we trust on the payment service providers to do the anti-money laundering and counterfeiting fraud, and we hope and trust that they would integrate that in the current fraud system so that it becomes as rich as possible, and we provide also a separate module to see things that are overdone. So it's a very important thing, but not something to compete on, and it's really something we need to do together. There are two things that you raised, I think, where digital euro really adds strong value. So first of all, this universal acceptance, because like cash, it's foreseen it becomes legal tender. So it is something you can trust that you can build and you can pay everywhere. And in that sense also, we think we can strengthen the European schemes, because to your point, they're very good initiatives, either already existing or growing, but covering 21 countries is a big stretch to make, and also in the coming 2, 3, 4 years, and I think even in 5 to 7 years. But if we would have a digital euro together with these schemes, there is always the option. If you can't pay with the European scheme, you can pay with your digital euro instead of needing to rely then, for example, on a non-European scheme. So universal acceptance is something that the digital euro will have by its nature, and can strengthen also Europe as a whole. Privacy has been in the design of the digital euro because I think people are specifically concerned with privacy towards the digital euro. There's some concerns on this. Mm-hmm. So let me reiterate again, the digital euro is designed to be highly private and to really make sure that we as a ECB euro system will not be able to connect any payment to a private individual. So this is very essential in our whole design, and then even with offline, we provide even cash-like, it's not 100% the same, but cash-like on privacy, also in the digital age, which is, I think, something very valuable. At least for myself, I have a shared account with my husband, and I love that I don't have to get cash to buy something for myself or to buy a present for him. But I can then still do it digitally. And then last but not least, I think we also want to make sure that the payment system remains an efficient system. Providing digital payments comes with a cost, so of course, and I think retailers understand that as well. But we also need to make sure that the system is efficient in itself, so that the costs are reasonable. And with having sufficient choice, we believe that is important. So there also the digital euro adds to making sure that there is sufficient choice and therefore sufficient competition in the market. On the digital euro itself, one important element which is stressed also by merchant is the fact that there is this legal tender in order to have this universal acceptance, as was mentioned. But that also means that merchants need to accept it. And the current draft legislation does put a protection for the merchant so that this is not misused. And we believe that as a total, the digital euro can really add to having a highly efficient, cost-efficient solution as well. And it comes with an investment. I mean, at some point, terminals need to adhere and to really make us independent from the non-European standards. But what we would foresee and would hope is that there's sufficient time to gradually update the payment terminals. We are happy that most of them are software downloadable, making it a bit more easy. But so that there's sufficient time to do this transition and that it follows a bit the natural evolution or replacement cycle that there is anyway. So sorry, it was a long story. I tried to address some of the points.
Okay, then thank you, Evelyn. Turning to Joachim on the private solutions that are already present, as you said, and how they are strengthening the European retail landscape, but also address the concerns that you've heard here from consumers and merchants.
Well, we have, I think fragmentation is the starting point. Then you have different ways to work with that. What we try to do is to say, we use a common infrastructure, which is SEPA Instant, and the public infrastructure from TIPS as a very important part of our system to make it easier to use and to lower the costs. And then you start to integrate these solutions who want to be integrated to one. Like the big one, the biggest for us after Paylib in France was or is Ideal in the Netherlands, which has a 70% market share in e-com. And nevertheless, they say, okay, it's better to combine our investments and make it one big solution, Vero, not only on P2P or on e-com, also on POS. This is, I think the best way to because then this, for example, Vero and Ideal is very good. The button on the e-com shops in the Netherlands is now Vero Ideal. So you see both. So the Ideal customer knows, oh, it's still Ideal. I can use it. It's a little difficult for German customers to see that because they cannot use it until now. Because first we have to switch it to the complete Vero transaction at the end of the year. But then all the consumers are migrated, as I call it. Yeah, they from the one system to the new one system. And they put by the hand, and it's the easier way to help them to get there. It's not that easy for the merchants because they have to do a lot of things. And as always with merchants, they try to get better deals. That's always sometimes the case. And it's also here the case. So it's always a complicated way, but I think they also want to stay on board with Ideal Vero and then with Vero. I think this is the one way to integrate the different solutions with the common infrastructure with, I think, a very technical advanced infrastructure here we have. The second one is these, as I already called, the interoperability task to overcome the fragmentation. And then there are countries which have only Visa, MasterCard. So they can choose, do they wait 3 to 4 years until the digital euro is coming? Do they go to a system like Vero or Visum, where they get this independence now, or easier independence now, and get the digital euro in 5 years? Because we already talked about it completely. We integrate the digital euro in our Vero wallet. That's completely clear, because we want to give our consumers also the choice to pay with the digital euro. That's the digital euro is part of the ecosystem, and it's there. And as a European citizen and company, we want to have that the digital euro will be a success and not a failure. So we have to work, combine. We talk about infrastructure, standards on the POS, and so on. We will talk to each other. But at the end, there's still a lot of complex decisions on the way we have to make. And for us, it would be easier if it's the same infrastructure, but we have now 2 different new infrastructures, offline and online, and all at the same time. I already told that, but that's how you call it in German, vergossene Milch. That's past time. It's now a reality, and we have to handle it, and we will do it together. But what for me is important, that we don't underestimate the time of the conversion of a consumer from one payment method to the others. And what we don't want to have, that's a combined goal, is they then go to Visa, MasterCard, and PayPal, because they say, oh, that's easy to use everywhere. I don't need these complex European things. There's a Vero and a Visum, and there's a digital euro. I think we have to invest together in this, and we cannot make it by statements like the European sovereignty, because the people like European sovereignty, but they do something else. That's we tried that once in Germany with PayDirect. We thought that trust is important, and that you need a huge security level. We never thought that with PayPal, people are buying expensive goods only with a username and a password. But they did it. All of them did it. Yeah? And if you ask them, will you do that? No, I will never do that. No, it's not secure enough, and I don't know where the data is, and so on. But they do it. So I think the impression that with statements you can convince consumers, that's my impression, it's not working. So you have to help them. You have to convince them. You have to have added values. And on the e-com side, what we think is the most important thing, each merchant is different. Each merchant has to be connected to the system with different needs. That's a lot of work, and that's complicated. And it's what we talked, it's not that easy that we have to make it more times. That's complicated, but at the end we will do it. And so long message, long talk, short message. Clearly the digital euro is part of the ecosystem. Or will come to the ecosystem. Clearly, we will support that and integrate that. But at the other hand, we want to work on our side, integrate the digital solutions that want to be integrated into Vero, and cooperate with them who say, I have this huge adoption with my consumers, like in Spain or like in Italy, and they will stay to that. And then we make this cooperation interoperability hub to connect them. So a German customer can pay in Mallorca and in Florence with Vero, with his saving bank wallet. That's my dream. I work for that.
Yeah, I think, but that was an important message because I think for some it wasn't that clear that actually both solutions can go hand in hand. I think it's often portrayed as an alternative or a competition.
There is a competition, but nevertheless it's there.
Yes, but you also framed a sort of coexistence in a way, and a form of interaction as well. So that's already an interesting and important message. But also you clearly raised both the issue of the acceptance in the end. You said that you can present solutions to the users, to the consumers, and say this helps European sovereignty, but they will do something else nevertheless. So again, I think bringing in the perspective of the consumers here, and we talked about already the need for inclusive payments, and you've already also raised the point that digital payments replace cash in many forms and in many aspects of life, but are they also creating challenges for consumers here? I mean, they're seamless, they're nice to most of us, but I think there's also more to it and more challenges to it, particularly to those who are more vulnerable. And then also, obviously, the second question that follows up is what steps can be taken to make sure that no one is left behind in a way with digital payments?
Yeah, I'll start with your last question, and the answer is simple. Keep printing. Not in an inflationary way. I need to be careful when I talk to central bankers about it. But keep printing. Cash cannot disappear. People are not ready. And especially, as you say, the most vulnerable ones, and not only. Again, we survey people to understand, and clearly they appreciate cash. And it's not only of people above 50s or the 60s, even among teenagers and younger consumers, because it's also a way to get to learn how to manage a budget, because you can see it, what you spend. So of course there is a need to maintain cash, like you say. Consumers need to get used to something, and clearly getting used to no cash is already a huge challenge, especially when we see that in a window of some years, we have 43% of bank branches that have closed. That means there are less opportunities for people not only to engage with your bank, but also to get cash. So this is something that we really need to keep insisting. While the ECB and the EU will develop the digital euro, will put it into circulation, we can also not forget that there is a need to have cash. Also, when we talk about inclusiveness, we also need to look at the design of digital means of payment. Something that we have been also supporting quite a lot, particularly in the context of the IRPB as well, is the full implementation of the EU Accessibility Act, because we need to make sure that anyone can make payments under all circumstances, and that also requires special attention. Just to give you one anecdote, one of my colleagues, she's deaf, and her BEU credit card, to book all my flights, to come here and other places, got blocked. The only option was to call and talk someone to deblock the card. Sorry. That's not very inclusive, Right. And she's an extremely literate and super competent colleague. So again, here, when we develop all these commercial solutions, including also and the public-based solutions, we need to think about inclusively that it works for everyone.
Thank you. David, also turning to you. You also have a very heterogeneous group of merchants there, yes. And they also face very different challenges, and keeping up with the evolving landscape. So what are your challenges that you see here?
It's a little bit difficult to say what are the different challenges between the different sectorial segments of the general trade. I can say something with the specific sector that I follow, which is this retail of consumer electronic and major domestic appliances. This is a sector that almost across Europe, in any country more or less, has reached only 20% of cash. So 80% of transactions happen with digital money. And we see that this tends to grow again, because nobody is buying anymore a mobile phone, or if it's not a fugitive, with cash. So it's quite and it's in that direction is going also because also the elder people, maybe they go to buy these products together with someone younger in the family and so on. So basically it's something that is going on. And of course the share of online sales is growing, and this is of course keeping high this number. So for the consumer electronics sector, also going in a direction cashless would be not so absurd, and it's something that we have to consider because the attitude of consumer is more or less similar in all the European countries that we can see. So also my country, also in Italy, now people use extensively the telephone or the credit card to pay. So cash is really getting for some products a secondary issue. I don't know, an idea that would be very useful to encourage adoption is, of course, the one of the incentives to consumers, especially to young people. I don't know, France, Italy, and others, when kids turn 18, they give something, an incentive to buy cultural products. Maybe to insert in the group of cultural products something that has to do with the financial education could be something interesting. It's a matter of education, starting from, I would say, I would focus on the younger generation for the digital euro. It's a generation of people that know Europe much better than anybody else. Okay, we are in a very international environment today, but if I talk to people of my age that have not this kind of job and so, they feel somehow European, but not so much. If you look at the younger people, they feel completely European. They study abroad, they go in Erasmus. This is even more than it is. And so this will be a way to be part of a community, I think. And so this is once again, it's a little bit commercial, but I'm here representing merchants, so that's it. This would be the focus I would give to the image of digital Europe, pointing on these younger generations.
Some advice for the Digital Euro Group. Yeah, that was very, very enlightening already. But this panel was also set up to look ahead into the future. And before Alexandra Hachmeister talked of the crystal ball in the previous panel, maybe we can talk about or think about a sort of wish list. Maybe it's also a to-do list for the coming 5 to 10 years. So again, addressing all of you. And again, I'd start with Joachim Schmalze first. As we look ahead, Joachim, where do you wish the European retail payments landscape to be in 5 to 10 years? That's quite a lot of time. We've referred before to where we were 10 years ago. So 10 years is quite a long time from now on. And what key actions do you think are most critical today to ensure that we achieve the vision that you may have in your head?
Yeah, my wish list is that the consumer in Europe can pay with the payment method he wants to have and is not obliged to use an US-American system. That's the wish list number one. And to support that, I think we need to combine the forces in Europe and not distribute the forces. I think that's the main pitfall we have, that the US competitors look at Europe and say, that's a nice thing what they do. They distribute their forces between different things. And this, I think, we should talk about how, and that's all what we try to do, how we can reorganize that and a little bit more look at as a combined effort to overcome the dominance, not only in payment system, but what I think is more important on US currency. It's, I think, a more important thing, but stick to the payment system, that our consumers can have the choice. And that's a long way to do, because all the others, the competitors, have much more money than we have, or are able or willing to invest, because they have this monopol rendite. I don't know how to call it in English. They earn a lot of money because they have this dominant position in the market, like Visa, MasterCard, or also PayPal. And they are eager to invest that. And on the other side, the Europeans are on the battlefield. It's better to combine the forces. That's my wish list number one, combine forces that we can deliver a solution where the consumers can have a choice.
Okay. We'll continue with Agustin, if you don't mind.
Yeah,
what is your vision?
I share his first wish, which is choice, and also choice among European solutions to start with. Also that we can beat the fraudsters, that we can develop a coordinated response so people are not afraid when making payments, that they might fall in a trap. And then the third thing is that in 10 years' time, or hopefully much less than that, then no one has the feeling of is left behind, because we have not designed something that is truly inclusive for everyone. So those are my 3 wishes.
Yes, thank you. Davide.
Oh, more than a dream, I have a nightmare of a system completely dominated by non-European infrastructure, where transactions take place mostly with, I don't know, crypto money managed somewhere else, with detriment also to the fiscal authorities, because you never know when something is below the line, you never know. And this is an actual nightmare. So the dream is that the world will remain more or less like it is, a little bit better. We can try to improve it with a step and not to change so much. If you allow me to make a very small example, in the typical 007 movie, the bad guy, when he's confronted finally with 007, say to him, I want to make the world better. You want to let it like it is. But 007 is on the right side, because they just want to improve a little bit and not to completely disrupt everything. And if we do the right moves, we can keep the welfare, the situation, the stability, the resistance, the resilience that Europe has, and we must all do our part.
Thank you. So Evelyn, there was a lot of wish lists and aims to ensure, but what is your vision that the ECB has in mind for the European payment landscapes in 10 years?
Yeah, the good thing is it doesn't include your nightmare, but it does build on the points that were made by Joachim and Augustin. So now what we foresee is that in 5 and 10 years we still have a landscape where there is choice. And not only choice between digital means of payments, but also that cash is still there. ECB is very committed to that. We're investing as well in a new design, and we're also supporting more on the legislative side, as you could have seen, on strengthening the position of cash. So we're very committed to cash. But it's a fact that we as a society go more digital. So we need also to make sure that people can pay there. And there I share the joint wish that we have a competitive landscape which has sufficient players, but they are European. And then let me add one wish. I think if we look where we stand now, if we take this point on the horizon, whether it's 5 years or 10 years from now, and we say, okay, what are the things that we need to do all together, the market, so both for the digital euro as the private means of payments, but also what it would mean for the merchants. If we make a good and clever roadmap, I think we can do this in a very good way. And then we would hopefully have an environment building on European rails, which really foster, in the end, where payments are for. They are there to make sure that we can do business and that we can grow and that we can innovate. So let's hope where I am in 5 to 10 years from now. Yeah, and the earlier, the better.
Yeah, and then we'll gather again and check where we stand, if we achieve those goals. I think this panel has very much shown that payments is much more than technical details, layers, and interoperability, but very much a social thing, something that needs to be socially inclusive. It's also a very political thing by now, that we need to think ahead and think about the different actors that we find today in a world where things have been more, let's say, it was termed ungemütlich in some of the previous speeches, so inconvenient and also a bit more hostile towards us in Europe. So this is a new landscape that we face today, but we also see that payments can bring people in a way together. Money brings people together, not just for business, but also for social reasons and to exchange in a very basic social sense. So join me in thanking the panel for their ability and their views and perspectives. And I'll hand over to Fabrice.
you. Thank you, Carola, and many thanks to also our final panel. So it falls on me now to try and bring together a few thoughts, a few common threads that I thought run through many of the conversations that we all heard today. And I think there are three common threads. I mean, there was a lot that was said, and I will be highly selective, and I will not necessarily do justice to every rich nuance in the discussion, but let me try. The first one is that digital finance and innovation in payments are not merely a question of technology. They are more fundamentally a question of sovereignty and strategic autonomy. The second thread is that starting from the realization that what is at stake is no less than the transformation of European finance, the task is both too important and too difficult, too enormous, to leave it to any one single actor. So we need a shared endeavor across the private sector and the public sector. The third one is that there is a clear momentum in making progress towards this transformation. Europe is moving ahead. So let me briefly flesh out these three themes, linking back to the discussions and conversations that we witnessed here today. The theme of sovereignty, it's by now a regular feature of any event of this kind. And today's conversations reaffirmed the centrality of this theme. But what struck me in particular was the multidimensionality and the richness of the concepts and aspects of sovereignty that our speakers brought to the debate. The president of the Eurogroup, Mr. Pierrakakis, stressed the risks of dependencies on non-euro denominated settlement assets. On retail payments, Mr. Dombrovskis, the commissioner, made a compelling case for the role of the digital euro in strengthening Europe's strategic autonomy. And in our final panel just now, both Professor Schmalzel and Evelyn Whitlocks explained how private solutions and the digital euro are working to build homegrown pan-European payment networks. Now, Europe is not the only region that is examining dependencies. Worldwide, there is a renewed focus on reliance on any single currency for trade, investment, and reserves. And President Lagarde, in her welcome address this morning, argued that digital finance provides Europe with an opportunity to overcome the fragmentation that is holding back European capital markets. In this way, it can help Europe attract a larger share of global financial investment and propel the euro to the forefront of digital asset settlement and cross-border transactions, a point that was also echoed in the remarks of Commissioner Dombrovskis. Now, Professor Brunnermeier added another concept of sovereignty in his keynote, which he labeled digital sovereignty. This recognizes that digital finance and innovation in payments also bring vulnerabilities centered around cybersecurity. And this brings me to my second thread, namely the need for a public-private partnership. A key insight from Professor Brunnermeier was that private incentives alone will lead to underinvestment in public goods like systemic cybersecurity, but also other critical aspects like interoperability or offline fallback capacity. This message was echoed by the president of the Eurogroup, Mr. Pierrakakis, who stressed that innovation must advance hand in hand with security and resilience, and that European investment in cybersecurity, cloud, and AI capabilities is critical. This key insight makes a very strong case for a genuine partnership between public institutions and the private sector. And I would argue this can be built on three mutually reinforcing foundations that came across in many of the discussions today: public anchors of trust, regulation and standards, and private investment and innovation. On the first foundation, Piero Cipollone emphasized that digital finance can only scale if it rests on what the public sector uniquely provides. Central bank money, which is the anchor of trust. As finance becomes digital, that anchor must hold in the digital world as well. This is precisely the rationale behind the Eurosystem's work on Pontes and Appia for wholesale markets, and of course, our continued efforts for the digital euro on the retail side. On the second foundation, regulations and standards, these are not constraints for innovation. They are enabling conditions. Legal certainty, common standards for tokens and networks, and regulatory consistency are what is needed to allow promising experiments to reach widespread adoption and become commercially viable investments. A stable and predictable institutional framework is precisely what unleashes competition and experimentation by the private sector. And we also heard the president of the Eurogroup and Verena Ross stressing the importance of not having a stable and clear regulatory framework, but in the particular European context, a harmonized framework across member states. On the third foundation, private actors are the principal architects of this transition on the commercial side. María Abascal, in her keynote, made the banking sector positions clear. Banks are ready to invest, but they need a regulatory framework that gives them the certainty to do so in scale. For incumbent institutions, the stake goes beyond adapting the current business model to a digital platform. Silvia Rovere argued they're being asked to redefine the role more fundamentally, moving from intermediation at volumes towards more specialized and genuinely advisory services. And Rita Camporeale added that a valuable role in this new environment for incumbent institutions is to handle complexity. Now, together, these three foundations define a synergetic architecture whereby public institutions provide what market incentives alone cannot deliver. And I would add that the statements that we heard in this last panel, in particular from Professor Smalzel and Evelyn Whitlocks, about private solutions working together with the public sector on the digital euro side, are perhaps one of the most poignant moments in this conference. And if I can add, also a statement that perhaps we wouldn't hear not so long ago. So that's a highlight for me from this conference. Let me turn to the third and final thread. It is fair to say that tokenization is not the dominant paradigm at the moment. Piero, you characterized the current value as peanuts in this field. But several speakers, starting, I think, with Verena Ross, and then echoed by many panelists, including myself in the second panel, identified an inflection point in this space, an inflection point towards broader adoption. Now, whether universal adoption will materialize in the 5 to 10 years that seems to have been the horizon that we've been discussing today remains to be seen. But what is clear for me from the discussions today and from our everyday interactions with the official sector and markets is that Europe is positioning itself to reap the benefits that this transformation can deliver. Across all sessions of today's event, progress and momentum were tangible. In wholesale markets, tokenization pilots are moving toward deployment in production. In retail, private pan-European payment solutions, as well as the digital euro, are advancing. In B2B, technology providers are embedding digital asset functionality into core systems. And in our policy panel this morning, the shared realization of policymakers, regulators, and central bankers of the urgency and importance of moving ahead was very visible. President Lagarde started the day today by asking us whether Europe is ready to preserve and strengthen its common settlement rails in a digital age. the discussions today suggest that the answer is a resounding yes. The challenge now is to translate the momentum into sustainable change. To do this, we must move from vision to implementation, from pilots to scale, and from discussion to delivery. With that, let me draw our conference to a close, but allow me to spend 1 or 2 more minutes to express my sincere gratitude to all those who made today's event possible. I would start by thanking President Lagarde and Piero Cipollone for their inspiring framing of today's discussions, but equally I would like to thank our policy panelists, Commissioner Valdis Dombrovskis, Eurogroup President Kyriakos Pierakakis, ESMA Chair Verena Ross, and Poste Italiana Chair Silvia Rovera. Our keynote speakers, Markus Brunnermeier and María Abascal, as well as all our moderators and panelists. Finally, my deepest thanks go to the colleagues across the ECB, and you saw and interacted with many of them today. They were the ones that made this event really possible. So I would like to, as I said, extend my deepest thanks and appreciation for their professionalism and dedication. So, closing, today's conversations build bridges across practitioners, policymakers, and academics. And if we bring this spirit of collaboration with us in the work that continues tomorrow, I'm confident that we can deliver the digital finance and payments ecosystem that Europe deserves. Thank you very much.